This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. This is a Thursday morning coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleague Sonia and Nigel. Guys, good morning.
Hi, good morning, Prashant. Good morning, Nigel. Well, lots to look out for in the markets today, but the moot point is the going has been good. The bulls have been on track and looks like that can continue.
Well, that's right. When we started this week, we thought we'll be getting the big cues coming out of the United States with regard to economic data, but we've got plenty of domestic cues. You've got the Kodak Mahindra Bank issue. You've got a lot of results as well. So, plenty on our plate, and today is the monthly expiry as well that will play out.
You know, yesterday evening, everyone in the newsroom, I can tell you, and our viewers, wrapping up quietly, nicely, Wednesday evening, looking forward to a Thursday. It was 3:30, I think, when the Kodak news came. Actually, around 4-ish when the news came. You guys had wrapped up market forward, and, I saw Surabhi in the newsroom, and suddenly there was pandemonium. So, yeah, I mean, it's something which we will discuss, the Kodak the issue with RBI, the RBI pointing out several lapses and, of course, taking action. But as we always do, let's start from the very beginning. What do you need to know as we begin a new session, right? So overnight, essentially, the handover has been extremely quiet. Quiet and lackluster equity markets is what we have. It's on your screen. The Nasdaq, nothing. The S&P 500, absolutely nothing as well. Do other markets respond? I'm talking about the rates market, the dollar market, nothing really. And that's been the problem all through this week that I've been pointing out as well. The equity markets have moved up a little bit every day. The yield, for example, not going past 4.7, not going under 4.6. It went up 4 basis points to about 4.64. Right before US markets opened, it actually was looking better. But then you had headlines out of the Middle East, which partially soured sentiment. So Israel essentially said that they'd struck 40 sites linked to Hezbollah in southern Lebanon. Of course, this was not unanticipated. They've been sort of talking about this for a while, but it came through. The other war, which of course is now over 2 years old, is the Russia-Ukraine war. And there you had US President Biden, who signed a package that would deliver military aid to Ukraine. So there's been a fair bit of chatter around this. In terms of how Ukraine is running out of money and aid is needed now. So that also happened, right? So that's geopolitics. But I think it's the former, not the latter, which really affected markets a little bit, soured sentiment, as I said. Oil prices, they held out around $88 a barrel. There's been no large spike or anything of that sort. Dollar index, it held under the 106 level as well. The USD JPY, it has gone past 155. Now, typically, you start to hear noises around intervention. Will the Bank of Japan, will the Ministry of Finance in Japan start to intervene to defend the currency? So far, nothing. Maybe not until you get the meeting, the Bank of Japan meeting. You also had results, and we've been pointing out how 5 out of the so-called Magnificent 7 companies are reporting this week. Tesla reported. By the way, Tesla sold off big time after hours, after they reported earnings in the last US session, not overnight, the previous day. But last night, Tesla was up 12-13%. The new result was Meta, which is Facebook, and they reported earnings after market hours, and the stock fell 15% in after hours. Now, with most of these things, what happens is by the time we hit air this in the morning and talk about the earnings, the conference call is underway, or people are parsing through if it's already happened, and that causes another reaction, sometimes as violently as it did in the case of Tesla. So watch out for that, but that's an important cue for our markets as well on the tech side. Now, just to sort of tie all of this into levels, Nifty closed marginally above the 61.8% retracement. That stands at 22,394. We left just above that level, 22,402. So that, in a way, if you want to look at the daily pivot, that still is the daily pivot, 22,394. Up or down. Now, the resistance for the Nifty continues to be in the zone of 22,427 and 22,503. 3 days now, the Nifty has been knocking at that zone and failing to take this out. So we'll see what happens today. The Bank Nifty, it closed above the 61.8% retracement. That stands at 48,111. On the way up, the resistance is in the gap area. And for the Nifty Bank, that is 48,255 to 48,477. We left off at 48,200 or so. So both the Nifty and the Bank Nifty are right in that sort of resistance zone, which are the respective gap areas. And that needs needs to be taken out for the Nifty to go to an all-time high and for the Nifty Bank to make more progress. On the way down, Bank Nifty has got near-term support at 48,021 and then 47,928. The Gift Nifty will come up on your screen. Given the cues we have from the US, etc., I mean, it's a nothing kind of a handover in that sense. Maybe the tech cues perhaps a little more important. You know, Meta sold off after hours, but if you look at some of the other stocks, I mean, I'm talking about the other large cap IT stocks in the US, mega cap IT stocks, they also in after hours sold off a little bit, 2-3% in that range. And that, I think, is the reason why a little bit of the Asian sort of screen is also looking a little down, a little red. Sonia.
Absolutely. The Gift Nifty is now down, I think, about 65 odd points, right? So indicating that it's going to be a soft start. But I'm watching out for a lot of individual stocks, and it's a mixed bag, right? There are some numbers which have been very good. And I think what tops the charts this morning is Axis Bank. Very strong set of numbers, and that will definitely aid the market sentiment. The revenues, the asset quality surprised positively. The loan growth was very healthy at 14%. So that could be the pillar of the market. On the flip side, of course, what happened with Kotak Mahindra Bank will not go down well at all. The central bank restricting Kotak Mahindra Bank from issuing new credit cards and onboarding new customers. That's something that could offset, Axis Bank's positive numbers. Another weak set of numbers came in from HUL, and I don't think there are any surprises here. The volume growth was expected to be 2 to 3%. It came in at 2%. The management commentary was not great either, but the stock has also underperformed quite a bit. So there is definitely low expectations and hence low disappointment for this stock. But for the markets, right, just look at it. I mean, the Nifty is up for 4 straight days now. The Nifty has gained almost 600 points from the April 18th low of 21,850. So it seems like there's nothing stopping this market. There may be some volatile phases, but it is an uptrending market given what we've seen in the recent past. Look at the way DIIs are buying in this market. 3,800 crores is what has come in from the domestic institutions in one single day. And it seems like, at least that's the indication from most market experts, that every dip should be bought in this market and the uptrend is pretty much intact. Now, today you have a lot of numbers coming through. There's ACC, Tech Mahindra, Bajaj Finance, IndusInd Bank that will be reporting numbers. Tomorrow you have names like Maruti that will be reporting numbers. So we have our hands pretty full. But I think, from just a market observer point of view, I think it's a really strong market that we have on our hand. We're not looking at global cues anymore because we have our local positive cues to deal with. Of course, today Kotak Mahindra Bank could, sour the sentiment a bit, but largely I think the going has been pretty good.
Well, that's right, Sonia. And today is going to be the monthly expiry as well, so there will be some volatility towards the final hour of trade in particular. The rollovers, though, they've been a little lower than what we normally see if I compare it with the last 3 months or so. What did the FIs do in yesterday's trading session? Well, they unwound some long positions, and that's what take the short positions to around 69%. And if you look at it in absolute terms, the total net short positions now from the FIs have gone to around 1.25 lakh contracts. Now, look at the swing factor. Just around 2 weeks or so ago, you had them being net long. So the swing factor that we've seen is tremendous because now, in fact, that number has come down to around 1.25 lakh. So that's a big swing factor, 1.75 lakh contracts in terms of a swing factor out there. A net short market, I'm not too worried about that. In the past, we've seen that the markets do bounce when we do see some short positioning out there. What about the options data? Because these options will expire today. 22,500 call, well, a fair bit of open interest built up out there, and the 22,400 put as well, a fair bit of open interest built up. But since the 22,400 put saw a fair bit of open interest built up, and the premium ended around 55 rupees, the average premium has been around 70 to around 80 rupees. So that's why the first reference point I'm looking at on the downside is 22,320, 22,400 minus 80 rupees. So that's the first level that I'm looking at. The 50 DMA, that becomes the crucial mark that we're looking at. While on the upside, the resistance zone has been the case and that continues to remain the case. Now, you'll have, the Nifty Bank as well, that it'll be interesting to see how it plays out because Kotak Mahindra Bank will start gap down. So in terms of a reference point, it's the Nifty Bank, it'll be quite important because the 50 DMA, the 20 DMA, they are crucial marks on the downside as well. So we'll keep an eye on that in terms of a reference point on the downside. Resistance, 48,500. Stock that I'm looking at, Dalmia Bharat. The numbers were very, very weak. In terms of a margin compression, it was quite a big miss out there. But the stock is 20% down from the highs that we saw in December 2023. So part of that bad news is in the price. And if you pull up an intraday chart as well, you'll see that towards the end of trade, there were some shorts that got added out there. So it starts lower, but I'll be interested to see whether or not there is some kind of short covering that takes place on this one. Numbers weak, no doubt, but how much of it is in the price?
All right, Nigel, thanks very much for that. So that's Dalmia Bharat. Keep an eye out on that one after earnings. Let's get you some views now. This is on the money markets. Parul Mittal Sinha, Standard Chartered Bank, says that the USD INR remained range-bound of the week with low volatility as geopolitical tensions eased amid active participation by local banks. She says rupee could outperform in the near-term scenario of USD strength, given forex reserves are near all-time high and positive rupee fundamentals. She says positioning is much lighter now, and they're expecting the currency pair to trade between 83.2 to 83.45 to the dollar in the week ahead.
All right, on the bonds, Parul says bond yields rose last week on geopolitical uncertainty, position adjustment and strong US data. However, she says yields fell this week as Indian government bonds turned a value pick with a 10-year benchmark yield near 7.25% with geopolitical tensions easing and oil prices declining. Amidst offshore overnight index swap inflows, she expects a 10-year benchmark bond yield to trade in a range of 7.1 to 7.25% in the very near term.
Well, we've got a lot of stock-specific action track for you. We get to that in just a bit in our special Top 10 segment. For the time being, we run you through the list. We look at Hindustan Unilever, Axis Bank, Indian Hotels, MAS Financial, Singen. Well, all of them will be reacting to positive news. We'll add to the list Macrotech Developers, that's low them. On the flip side, Kodak Mahindra Bank, LTI Mindtree, Dalmia Bharat and AU Small Finance will be reacting to negative news flow.
Okay, well, that's the sort of lineup here in terms of stocks which we will address. Arvind Sanger is with us, Managing Partner at Geosphere Capital Management. Arvind, good morning. Great to have you with us here. Thanks very much for your time. You know, the global markets overnight were absolutely quiet. So if you may, let me start with something local. The Kodak news, which came yesterday from the Reserve Bank of India, I'm sure you saw it. The bank, RBI, has essentially asked them to stop onboarding new clients through online and mobile platforms. They've also asked them to stop issuing credit cards. There's a comprehensive audit which is needed with the prior permission of RBI, and then post that, they can resume. This is similar to what we saw with HDFC Bank, and that issue saw almost a year and a half plus to get resolved. Your thoughts, prima facie, Arvind, on this one, Kotak Bank?
Well, it's clearly not a positive. It's clearly something that's going to take a while to work through. I think the RBI has been quite active with some of the NBFCs and some of the banks in terms of making sure that they have a good handle on a lot of the KYC and all of this onboarding. So I think it's going to put, frankly, it's going to put Kotak Mahindra Bank on the back foot for a while. But I don't think it fundamentally is a structural problem at Kotak Mahindra. I would say that it's not a stock that we are currently involved in, but it's something that if the stock gets punished too much, we would be interested because this is a high quality franchise. This will be a bit of an impediment in terms of short-term growth, but.
Oops. Okay. I think there's some issue with his video. Arvind, we'll just come back to you in a bit. So we got, what you're trying to say, that there is an impediment to short-term growth for Kotak Mahindra Bank, but not too concerned about sure. Arvind, I think we can hear you again now. Go ahead. You were telling us about, your view on Kotak.
Oh, I'm sorry. My internet may have been a little slow. But yeah, my view is that, short-term growth may suffer, but I think any meaningful pullback for a high-quality bank like this would at some point be a buying opportunity.
All right, got that. The other positive is coming from Axis Bank. Very strong numbers, asset quality has improved. And, it just goes to show that the strength of these private banks is something that sort of continues, right? It's been 4 or 5 quarters now. We've had some really healthy numbers. Would you look to raise your investments or raise your sort of allocation to some of these private sector banks?
Yes, we like the high-quality private sector banks. We think that they have lagged a little bit in the last few quarters, and we are interested in high-quality banks, whether it's an HDFC Bank or it's or an Axis or a Kotak. Notwithstanding the short-term headwinds, these are places where, given how frothy some of the small-cap names have gotten, we're finding better opportunities in some of these areas. So yes, we think that this is a cycle where the loan-to-deposit ratio had gotten a bit of a problem. It seems to be getting to be less of a problem. And I think, again, if we're going to have, as we believe we will, a sustained economic cycle in India, then private sector banks are going to be at the forefront of it in terms of driving the financing needed for that growth.
Okay. Hi, Arvind. Good morning. Preference for the high-quality private sector banks. So we've spoken enough about the banking names. Let's talk about the other pillar of the market. That's tech. You know, I have a couple of disappointments coming in there, whether it was Infosys, whether it's some of these other companies like Persistent System, LTI as well, Tata Elxsi, some of those mid-cap, mid-sized IT companies that grew very, very rapidly. Valuations seem to have become a headwind. And now some miss on results, well, they're getting pulled back. How do you approach the tech space here in India?
Well, I think that, we've been, frankly, not invested in the tech space. But if we get some pullback in mid-cap companies, the opportunities we're looking for is those who are going to be able to be beneficiaries of the whole, tech build-out in terms of the new AI world. And right now, we're not sure who is going to be able to benefit because the big headwind, this is not the short term. Now I'm talking about valuation. If I'm looking out, we're looking at investment that makes sense 2 years from now, 3 years from now when we're investing. We're not buying for a trade. And if we're looking at that, one of the big headwinds is going to be that AI causing displacement to a lot of the low-level kind of programming that is done by a lot of these tech companies, particularly the big ones which serve a lot of customers. And so that structural headwind has kept us on the sidelines. Some of the smaller companies, we're still trying to evaluate which ones are winners and which ones are losers. But I do think that, yeah, you're right, that the valuation that run away from us, so we did not feel comfortable chasing after them. I think that the challenge, in our opinion, is trying to discern the winners from the losers, because let's be clear, unfortunately, a lot of the mass market kind of serving IT companies over the next 2 to 3 years are going to be facing structural headwinds from AI.
Arvind, just a quick word on the sort of global setup. I mean, equity market setup. Is this a risk-on phase? Is this a neutral kind of a phase? You know, for example, the India Wix here sold off about 20% 2 days back, or day before yesterday. I mean, is that it? Because election results here are usually in May. This time they're in June, early June. No exit polls, nothing, all the way till early June. So is that indicative of a more quieter period here? I'm talking about the near term, month and a half or so. Arvind.
Well, in the next month and a half globally, I think we're in a kind of an in-between situation. Clearly, the Fed is on hold. And inflation data is looking questionable as to whether it's going to come down as quickly as expected. On the other hand, ECB may be ready to start cutting rates, and give more signals towards the rate cut coming. And then in India, you have this hiatus where, election uncertainty, a lot of good news in terms of assumption that there's going to be continuity on the government front is probably already in the stocks. So I think that this is going to be probably a period where, risk on is not going to be a big dominant theme in the next month. So I think it's time from our standpoint, to be selective and to be opportunistic. I don't think this is a time to aggressively chase after equities. And we would use pullbacks from any global cues or any negative surprise in India, company specific or otherwise, as opportunities to buy. But we're not super bullish about the next month, either globally or in India, given that investors are going to look for clarity on both global inflation front and India election front.
All right, fair enough. So you're not super bullish on this market at the moment, given the kind of run-up we've seen. Got that. Thanks a lot, Arvind, for joining in, and have a great day. Let's take a quick commercial break. On that note, on the other side, our list of top 10 stocks is lined up. Do stay tuned in. Today is actually a news-heavy day because you have plenty of stocks to talk about. So let's not waste any time and get straight to our research team. Kotak Mahindra Bank will be under pressure today, of course, for obvious reasons. But Abhishek is here to, give us a lowdown of all that happened in the last 12 hours. Abhishek, over to you.
Well, RBI has taken action against Kotak Mahindra Bank, Sonia. So RBI asked Kotak Mahindra Bank to stop issuing new credit cards as well as onboarding new customers on its online as well as digital platform or digital banking app. So RBI has observed serious deficiencies and non-compliances that they have observed in Kotak Mahindra Bank, areas of IT inventory management, data security, and a whole list of area has been actually mentioned by RBI in its release. Bank is found to be materially deficient in building necessary operational resilience due to failure in its IT system and the control. So credit card portfolio, if I take a look as per the Q3 FY24 numbers, the bank grew that book by 52% YOY and about 10% sequentially. One of the most profitable business is the credit card business for banks, and the total book stood at about 13,880 crore, which formed about 3.9% of the loans. So a strong growing segment as well as high margin business gets impacted from RBI's diktat. Back to you.
Okay, all right, Abhishek, thanks a lot for that. Well, let's focus on a number that came in post-market hours. Mangalam joins us to tell us about Hindustan Unilever. Mangalam.
Well, the street wasn't expecting too much from Hindustan Unilever this time around, and the company did not disappoint them by not delivering too much as well. So if you just take a look at the revenue, the EBITDA, the volume growth and the net profit, they were absolutely in line with what the street's muted expectations were. Just 2% volume growth, a mild decline in the revenue, and the net profit a little above that 2,400 crore mark. In the segments, the beauty and personal care segment actually saw a decline of 3% as against street expectations of 1 to 2% growth, but that was offset by price growth in their food and refreshment segment, which saw a revenue growth of 3% as against an expectation of just 1% growth, and this was largely led by hikes in coffee prices. The gross margins of the company, they increased by about 300 basis points, but that did not reflect in the EBITDA margins, which declined by 20 basis points, and that's largely because of a couple of factors. One, they increased their ad spends by about 200 basis points. The deal with GSK that got terminated took away about 60 basis points, and also the royalty increase to the parent took away about 35 to 40 basis points. The management said they saw gradual recovery in rural. The parts of the business that are doing well are the ones that are doing well for everyone. That's premium, beauty and personal care, as well as modern trade channels. And they expect low single-digit price decline going forward. The stock hasn't done much, but on these results, there's no reason to either buy or sell. So maybe a mild green at best for HUL.
All right, Mangalam, thanks very much for that. That's HUL in focus. Now, Kodak is the drag on Bank Nifty today, but could Axis be the lift? Abhishek is here with details on that one. Abhishek, morning.
Morning, Prashant. So Axis Bank could be the, stock of the day. Beautiful Q4 FY24 for them. Records galore over there. Gross NPA ratio is the lowest in last 34 quarters. Net NPA ratio is the lowest in last 35 quarters. Now, net interest margin was expected to decline as per analysts estimate anywhere between 8 to 10 basis points. And, despite CD ratio declining for them, the net interest margin has actually improved by 5 basis points overall for the bank, led by the fact that 8 basis point improvement was seen in their domestic net interest margin. ROA has touched 2% for the first time that I am seeing in last 9 years. ROE has touched 20% plus for the first time that I am seeing in 9 years. So annualized slippage ratio is at 1.44%, lowest in last 14 quarters. Analysts were estimating slippages to be in the range of 3,750 to 4,300 crore, but it has come in a little more than 3,400 crore. CASA ratio has improved for the first time in last 3 to 4 quarters. PNL, both the NII and PAT is ahead of our poll. Other income has also aided the PAT this time around. Back to you.
All right, got that. Thanks a lot. Reema is with us to tell us about LTI Mindtree. Reema, how did it look?
Well, it's disappointing. Revenues and margins have come in lower than street expectations. The company's revenues on a constant currency basis, it's declined by 1.3%. The street was anticipating a decline, but not to this extent. Margins too have fallen for the third consecutive quarter and come in at 14.7%, dropping by 70 basis points on a quarter-on-quarter basis and lower than street expectation. In the conference call yesterday, the company did say they will return to growth in Q1. Q4 was an aberration. There is no change in the discretionary spending. There is still a lot of caution, and even on margins, because margins have been disappointing for the company, they're talking about a gradual uptick in margins. Nomura has lowered the EPS estimates by 4 to 8%. Morgan Stanley has cut the target price to 4,600 post this disappointment.
Okay, Rima, thanks for that. Well, Mangalam's coming back to you. Indian Hotels, numbers look good.
Very good numbers this time around. And this is seasonally not even a strong quarter, but despite that, the company has reported the best ever fourth quarter. Margins expanded on operating leverage. All the thesis that, one expects from the hospitality industry are now playing out, and the new businesses that the company has seeded has grown at 2 times the company's overall average. So revenue growth of 17% has actually led to a 23% jump in their EBITDA. 660 crores what the company's reported, and the net profit has jumped by about 29%. We're looking at a number closer to 440 crores. Occupancy for the year was 75%, which compares to 71%. Average room rates increased by about 7% to around 12,600 as well, with management fee revenue coming in at 468 crores. The company is also given a strong FY25 guidance with double-digit revenue growth likely, with new businesses being about 30% of their sales, and they will open 25 hotels in FY25. So all of this should bode well for the stock, despite the big run-up that we've already seen.
In fact, we will be connecting with the management of Indian Hotels at 10:15 a.m. today to discuss more about their Q4 earnings. Do stay tuned in for that. But Dalmia Bharat is the other one that you're looking at.
Well, disappointing numbers, Sonia. You know, the stock ended actually at the low point of the day in yesterday's trading session. So the street was sniffing that maybe the numbers will not be too good. And as I mentioned earlier, the stock has corrected 20% from its 52-week high. The revenue, that was a little bit better. Why was that? Because volumes were better. Now, the volumes, as in all probability, have come in better because of that deal that they have with JPA. You know, so the tolling volumes would be higher out there. But that's come at the cost of margins, because margins have seen a sharp decline. We were expecting more or less stable margins. So that was a bit of an issue. The profit number, though, looks better because of higher other income as well as lower tax. What's the reason for the margin miss? The key reason is realizations were down by 7 to 8%. The street was working with a contraction of around 4 to 5%. So higher contraction out there. Cost as well were higher. Freight costs were much higher. Other expenditure as well was higher. And if you're looking at the purchases, well, they were up, telling you that clearly those that tolling deal has impacted the profitability out there. And the profit number, it looks better, but it's actually because of a couple of one-offs. So that explains why. I expect the stock to open up in the red, but from there we'll have to see how it does.
All right, Nigel, thanks very much for that. So we'll keep an eye out on that one, Dalmia Bharat, the open, and then, of course, what happens later, as Nigel pointed out. Now, AU Small Finance Bank and Mass Financial are the other two names we are focusing on. Back to Abhishek for those. Abhishek, back to you.
AU Small Finance Bank could also be in red given the fact that net interest margin is at 15-quarter low. Net interest margin has come in at 5.1% versus 6.1% in the same quarter last year and about 5.5% in the previous quarter. Return ratios also continue to deplete. Both the ROA and ROE have declined both YOY as well as quarter-on-quarter. So asset quality is the highlight over here in terms of positivity. Gross NPA ratio is down 32 basis points on a sequential basis. Net NPA is down about 13 basis points sequentially. In terms of the PNL, NII is below our poll. However, on account of robust other income, the PAT is ahead of our poll. Mass Financial consistency continues over here. They have been consistent post their listing. So disbursements are up 15% YOY and more than 5% sequentially. AUM growth is strong at about 25.1% YOY and 4.7% sequentially. NII growth is robust at 39% YOY and about 11% quarter-on-quarter. Rare instance to see, the calculation does show that net interest margin might have improved both YOY and quarter-on-quarter for a lender. The PAT is up 22.7% YOY and about 9.1% sequentially. The only flip in the result is the gross NPA ratio, which has inched up by 2 basis points on a sequential basis. Back to you.
All right, thanks a lot for that. Let's hop across to Ekta now. She's going to talk about Singen and why she's watching that one. Ekta, over to you.
Thanks for that. Well, numbers, I'm watching Singen because of its Q4 performance. Multi-quarter high for margins. So that was the big positive for Singen, which came in at around 34%, the best that we've seen in around 7 to 8 quarters for the particular company. But what disappointed was a revenue decline in Q4. It declined by around 7.8% versus expectations of around a 5 to 6% growth. So I think that would probably be the key disappointment for Singen. Profit was up around 6%. The other thing which was actually positive for Singen was that there was a Q-on-Q recovery, which the company had alluded to in the previous quarter. Revenue was up 7.4% Q-on-Q. Margins, like I mentioned, were at multi-quarter highs, and the profit was higher higher at around 188 odd crores. For FY24, revenue was up around 9 odd percent. They missed their guidance of a double-digit growth in FY24. And all of this has taken place because of the slowdown in the US biotech funding space, and they are expecting a recovery to take place there. For FY25, the guidance is high single digits to low double digits with momentum building through the year. So that should be positive. EBITDA to be similar to FY24, which was around 29%, and profit in single digit growth. So based on the revenue decline, I expect the stock to probably be in the red, but the margin strength should probably offset the weakness.
Right, Ekta, thanks very much for that. So keep an eye out on that one. Now, Macrotech Developers is the next one, and Sonal has got details here. Sonal, morning.
Good morning, Prashant. Well, we already got the operational update in terms of pre-sales, but now the company has gone ahead in their Q4 numbers, given the outlook for FY25 as well. They are looking at sales of 17,500 crore rupees. That's the bookings. That's a 20% growth that they're expecting, which is in line with their earlier targets as well. Cash flows from projects is expected at 21,000 crore rupees, and net debt to equity is expected to be around that 0.5 times mark, and they have raised funds via QIP as well. In FY24, they said price growth has been to the tune of 5%. They've done launches of 5 million square feet and handovers of 1,809 units. The net debt stands at 3,010 crore rupees. But additionally, as they've raised some equity as well, that has added in terms of funds to the tune of 3,300 crore rupees. Their cost of debt has also come down. The company says that Palava and Upper Thane is set to deliver sales of $175 to $200 billion in next 3 decades. That's 30 years. So that's the kind of guidance that they've given in the investor presentation, and margins of 50% from those projects. Jeffrey says overall growth and deleveraging part stays intact, and that's why they're bullish on the stock. Okay, I've heard of Thane, but I haven't heard of Upper Thane. Okay, every place has a lower Parel. Now, you know, there's a Upper Juhu as well now. Yeah. So I don't know what that means, but there's an Upper Thane.
I mean, I think it's the ingenuity of real estate developers, right?
Yeah.
I mean, that's branding. I think it's you could Juhu and then you add something to it or whatever. And it's what is happening all across
Is
cities.
that Upper Bandra?
No, I've seen a lot of, maybe it'll be redeveloped Bandra, no? Because there's so much of redevelopment.
No, it's got no zing to it. It's got to have something else.
Yes. But Bandra's Bandra, old school, vintage.
Bandra doesn't need an Upper Bandra, to be honest. But all right, let's do a quick recap of all our top stocks in focus. Stocks with positive news flow. There's Hindustan Unilever, Axis Bank, Indian Hotels, MAS Financial and Macrotech Developers, while stocks with negative news flow, Kotak Mahindra Bank, LTI Mindtree, Dalmia Bharat and AU Small Finance Bank, along with Singen. But let's find out what's happening in the world of commodities today. Manisha Gupta is joining in. Manisha, what's the latest there? Good morning.
Morning, Sonia. Thank you for that. Well, we've seen some gain come back in case of commodities. So crude oil prices are back above $88 a barrel. This is because the U.S. inventories have seen a big withdrawal of 6.4 million barrels. Markets were anticipating a buildup of 1.5 million. So this is quite on the contrary and a big number at that. So that is what seems to be supporting markets. The street is also waiting for the U.S. GDP and the personal consumption expenditure data. That would give you cues about inflation and the rate cut cues going forward. So that is what the street is waiting for. But it's not just crude. There's a smart rebound that we are seeing in metals. So the gold and silver prices are back at around multi-week highs at least. Gold is back above 2,300 and silver prices gained 2% overnight. Within metals, we are looking at copper holding its 2-year highs. Iron ore prices have rebounded to a 6-week highs as well. There is renewed demand from China, and lower shipments in the month of April also seem to be supportive for many of these metals.
Thanks a lot for that, Manisha. Well, for the time being, we'll slip into a short break. On the other side, we'll be joined by Dipan Mehta, Director at Elixir Equities, for some fundamental stock research. Later on, we'll also be joined by Abhisar, Partner and National Leader Financial Services at EY India, to discuss RBI's action on Kotak Mahindra Bank. Stay tuned. Welcome back. You're tuned into Bazaar Morning Call. Well, Dipan Mehta, Director at Elixir Equities, joins us to help us out with some fundamental analysis. Hi, Dipan. Good morning and good to see you. Well, what do you do with Kotak Mahindra Bank? High-quality name. The solace is that it's not rallied. It's not seen a big outperformance. But this news is clearly a negative out there. It'll slow down their growth, and also if the unsecured book does slow down, it could have an impact on margins. Your take?
Good morning, Nigel, and thank you for having me on your show. Yes, I think very negative news for Kotak Bank. But look, it's a solid institution and a very strong brand. And these kind of setbacks are temporary. I'm sure they'll work around it in terms of technology and in terms of their capability to execute. Kotak Mahindra management clearly has an excellent track record. So this could be a passing phase. But yes, I think sentimentally the stock will take a drubbing today.
Okay, sentimentally the stock will take a drubbing, but you're saying for people who own Kotak Mahindra Bank in their portfolios, one shouldn't be too worried, right?
Okay, yeah, good morning, Sonia. Whenever there's a correction in the stock price and I expect 4 or 5% up for correction, it does cause a lot of angst amongst investors, especially Kotak Bank would typically be amongst the part of the core holdings of many investors, being a large bank and having created so much of wealth. So, if you are holding it for past 5-10 years, anyway, it has rallied and become a large part of your portfolio. So certainly it will dent the returns for on a cumulative basis. And these kind of developments do tend to, does shake the investor a little bit. But if you have a longer term view and expect that the management has the capacity and the capability to resolve these compliance issues, then the bank should come back more than ever strongly on a more stronger tech platform and hopefully be able to avoid, such setbacks in future.
But the problem, here is that if you remember, HDFC Bank also saw a big derating, right, after RBI's action had come through. So the problem is that even if you have a long-term view, is there an opportunity cost elsewhere? Because, names like Axis Bank are doing so well in terms of numbers, etc. So that was my only point. Your thoughts?
At the end of the day, I think, there's always a rolling leadership amongst the banks. Today, Axis Bank did well. Tomorrow it will be Kotak Bank and then HDFC Bank and ICICI Bank's turn also comes. There was a time for several years where HDFC Bank and Kotak Bank, had best-in-class performance, and ICICI and Axis were kind of struggling. So this kind of churn does keep on happening when you start to rate the performances. But end of the day, I think these are great institutions. There's secular growth story still over there, and if you expect India's GDP growth rates and corporate profits to grow the way they are, then private sector banks certainly have a very important role to play. The balance sheet size certainly can support credit growth within the country. So I'm not too perturbed about longer term growth rates for any of these banks. It's just that over the short term, maybe they're overowned, maybe there's a liquidity issue because of which their NIMs are being compressed, over ownership. There are many factors, but by and large, I think if you just look at the longer term trajectory 3 to 5 years from now, these companies will be significantly larger than what they are just now, and there's adequate headroom for growth.
Deepan, hi, morning. Rolling leadership, right? That's, I think, the absolute apt way to describe it. Rolling leadership in the market as well. Something or the other is always there performing, and that keeps things up when something is not performing. Now, from yesterday, I wanted you to react to a few names because there is, in a way, a different kind of rolling leadership here, right? Momentum has been strong in the broader market. So, comment if you will. UBL ended 10% higher. That's United Breweries, the beer company. You had the standalone refiners, CPCL, MRPL, which were sharply up. If you want to sort of weigh in on that. Not many cows track it, but react. It's never small. It's always big when the stocks move, those two. And then metals, SAIL was up 10% and a bunch of other metal names as well, if you want to. But start with UBL, Deepan.
Yeah, Prashant, good morning. I think UBL, if I'm not mistaken, numbers also came through. And
Heineken reported numbers. And they kind of said that India business volume growth is in the low teens, is what they said. So it would be higher than the last couple of quarters if it were to be in that vicinity. Yeah.
That's right. And also it's a sweltering summer. So you can expect beer sales to do extremely well in the next quarter. That's the current quarter as well. And look, United Breweries, I think is really a very strong pick among the Alcobev segment. It has got a very high market share, I would say less competitive intensity as compared to United Spirits, which has to deal with many of the strong local players, and then there is an international player also which is competing, whereas UB per se has got, I would say, slightly less competitive environment. And there's always hope that some relaxation in regulation may permit more sales points for beers, and that benefit United Breweries, and it does therefore trades also at a premium multiple. But look, investors wanting to get into an allocation in the FMCG space, then you have to work through stocks like UBL, maybe a Tata Consumer, which have a significantly higher growth rate. So I think that the move is justified, but the stock is quite expensive.
Yeah. Deepan, the other two, I'm just going to ask you to respond, but Mr. Birla is on the air. He's speaking right now, so let's cut across.
Successful conclusion of India's largest FPO of 18,000 crores marks one such turning point for the Indian telecom industry. The fact that so many marquee investors participated in this equity issuance is a testament to the government's vision of a digital India. The emphatic oversubscription of the FPO, with the overall book being subscribed 7 times and the institutional book being subscribed 19 times, demonstrates the tremendous potential of the India digital story and Idea Vodafone's role in it. The robust engagement from both foreign and national investors is heartening, and notably the full subscription of the retail portion is truly commendable, given the sheer scale of the offer. Vodafone Idea's journey to this point has been shaped significantly by the government's path-breaking reform package, which has nothing short of transformed the entire sector. I thank the Honorable Prime Minister, Shri Narendra Modi ji, the Honorable Finance Minister, Srimati Nirmala Sitharaman, and the Honorable Telecom Minister, Shri Ashwin Vaishnav, for their leadership and unequivocal commitment to preserving a competitive 3-player market. The policy environment today, I believe, encourages investment, innovation, and competition. India's digital economy is, as we know, booming, and robust telecom networks are crucial to support this growth. A nation of 1.4 billion people deserves 3 private telecom players. Vodafone Idea today is not just a telecom company, it is a national asset with 215 million users, about 8,000 megahertz of spectrum, and a network that spans Kashmir to Kanyakumari. The Aditya Birla Group, as many of you know, has remained committed to this sector for over 2.5 decades now. Along with our partner Vodafone Group, we have cumulatively invested around 170,000 crores in the Indian telecom industry. Before this IPO, in the last 5 years, out of 30,000 crores raised by the company, more than 75% has come from the two promoter groups. The latest fundraise has also seen an investment of over 2,000 crores from the Aditya Birla Group. This continued commitment stems from our belief in the promise of the India digital story. The proceeds from this fundraise are earmarked for a significant capex. This growth capex will pave the way for a network and technological upgradation across key markets, and this in turn will enhance operational efficiencies and lead to better performance. The cycle of investment will therefore trigger the cycle of growth. On the back of this fundraise and continued support from banks, I am confident that Vodafone Idea will stage a smart comeback, and this moment in many ways marks the beginning of Vodafone Idea 2.0. I believe that a revitalized Vodafone Idea is important for India. I want to take a moment to acknowledge the relentless spirit of Team Vodafone Idea, from network technicians and marketing executives to customer service agents to the senior leadership to the V team, has demonstrated extraordinary commitment, resilience and tenacity. Amid storms of uncertainty, they have remained undeterred, day in and day out. In fact, it wouldn't be an exaggeration to say, what a team, Sergi. I also want to thank the 215 million users who have backed the company through thick and thin. Their support is the very foundation on which Vodafone Idea will grow. A heartfelt thanks to also our bankers, Axis Bank, Jefferies and SBI Caps for this blockbuster FPO. Once again, I'm grateful to everyone who has believed in, invested in and committed to the vision of Digital India. A vision that will continue to drive Vodafone Idea forward. Today, as we stand on the cusp of a digital revolution in the country, a rejuvenated VI, together with other telecom players, will meaningfully contribute to the exciting and sustainable growth journey ahead. Thank you.
All right, well, what a turn of events it has been from being completely beleaguered over the last couple of years to, of course, sounding optimistic. Mr. Birla himself talking about what has happened with Vodafone Idea and the bright future, as he sees it, the company has in front of it. It should be in focus along with the rest of the telecom space today. Well, the other big story, of course, is Kotak Mahindra Bank. The RBI has stopped Kotak Mahindra Bank from onboarding new customers through its online and mobile banking channels. It's also asked it to stop issuing fresh credit cards. This comes after the RBI cited concerns over Kodak Bank's compliance and risk management practices. Let's take this forward. Abhizar Divanji is partner and national leader, financial services at EY India. Abhizar, good to have you with us here. Good morning. Thanks very much for your time. Another one. Just your thoughts, and how is this different from, what we've seen in terms of actions from the RBI? Say, for example, the last big one was the HDFC Bank one, but we've had so many others in the interim. Go on.
So, one thing I liked about this is that in this one, RBI has come out with a 1.5-page document, as against what I saw earlier, were 2 liners saying, in exercise of our powers, somebody can't do this and somebody can't do that. So the good part is this time RBI has come out much more clearer as to what it believes the issues are and has taken responsibility for enumerating those issues. And I think, again, the issue remains the same. There's no change that's happening overnight. IT is a big part of the banking industry now. And as banks transform to be more and more technology savvy, we are going to see newer processes. And the regulator is likely to have issues with those newer processes. And there is a ongoing process where we try and rectify them and remediate them. So I think this is part of that. It's extended to banks beyond just NBFCs earlier or the tech companies like Paytm. It's extended beyond. HDFC was one of them, which was earlier also told to rectify processes. But one important thing one needs to understand is that the industry, the banking industry, is transforming to a more tech-based platform. And if that is happening, I think the regulator should work concurrently with the banks to make sure that they also upgrade themselves onto what are the acceptable policies and processes that will be there going forward. That's more important. I would not like to comment on whether the regulator has correctly or incorrectly banned, but I would like to say one thing. Now that the regulator has come out with more enumerated reasons for why it has done, if it were to be more specific and come out with more specific reasons, and then tell all the other banks who are yet to be inspected that if we find the same issues with you, the consequences will be really bad. That is how they will bring about systemic change in process, rather than singling out a particular entity.
So, I had 2 questions in this, Abhizar. Hi, good morning, and thanks for joining us. One, why is RBI so worried about the digital space, right? What seems to be the primary concern there? And 2, it's very obvious that now with what they've done with Kotak Bank, this will affect growth in the medium term. So how can they ensure that growth is not hindered, but at the same time, guardrails are put in place?
Okay, so 2 separate questions. One is for the regulator. Why is the regulator so skeptical?
Yeah.
First of all, Sonia, any change will bring about skepticism. So that is quite acceptable, whether it is from the regulator side or from the bank side. What is important is that with every skepticism and every remediation, both sides need to show confidence that the system is changing towards a more tech-oriented platform, and those tech-oriented platforms will define newer processes. What's also happening, and what's important, is that initially there will be teething troubles everywhere. There will be customer complaints, there will be stoppages, but those are part of a learning process. That will be slightly more a proactive way or a more better way of looking at it, to say how we can improve our processes going forward. There will be stumbles. Whoever are the leaders in the technology are going to be paving the way for a smoother highway for the future guys to come. So that should be the intent. And I think that is the intent of the RBI as well as of the banks. So constructively working together and remediating is the best answer. Second issue is what you asked,
on growth.
Around growth. See, now, very frankly, as long as if you have issues like Paytm, where the licenses are completely cancelled, there is no question of it. But where you are looking at temporary stoppages till procedures are sorted out, I think there is also an ability for a bank to sit back and reflect as to what are the issues that are happening, and frankly decide which customers it wants to service better, which customers it maybe doesn't want to service and they were incorrectly taken on. So I think there is going to be a rationalization in how banks will perform, and I think that is going to lead to a better performance. Just give it a quarter of a breather, I would say. But thereafter, you will actually see more superior performance. We've seen that in HDFC, and we will see it, I think, in other banks that have been through a similar process.
All right. Hi, Abhi sir. Good morning, and thanks a lot for joining in. Well, what about how long do you expect things to get sorted out? I think for HDFC Bank, it took around 15 months or thereabouts. The street will look ahead. They'll want to know what could the potential timelines be. What would your best guesstimate be?
Tough. That'll be tough. But I think what would happen is that, see, immediately you will see some results when a rationalization of customer bases happen. That result is immediate, because you will see that the focus is on better, more reliable, more compliant customers will go up. This is not a stoppage of activity. So I think that the customer productivity on that will keep going up. Newer customer additions may see a setback, and it may take 1 or 2 quarters, for example, for banks to rectify that. I would actually say that if a bank said that they can remediate everything in 15 days, then that would be a fake remediation in my view. So if it takes actually a good 6 months to 8 months to rectify it, I think that's a fair time frame to get back on track.
All right. Abhijit, good conversation as always. Thank you very much, and thanks for that perspective. Useful as always. Thank you. Well, that's Kodak Bank, and we will continue to get you more perspective through the course of the day on that important story. But Anuj is here with how he's looking at the market and the setup. Anuj, good morning.
Morning, Prashant. A lot of big events today. Of course, I'll start with the banking event. You were just discussing that. Kotak versus Axis, and I think that's going to provide some kind of balance in the bank nifty today with the RBI news on Kotak. Kotak's likely to open with a big gap down, though 1650 to 1700 is normally a level at which you see some buying in Kotak Mahindra Bank. Axis Bank came out with what I thought was perhaps the best earnings in the near history and really soothing on the eye. So that sort of should balance each other out, and expiry is out of the way as well. The other big event, of course, which we were just discussing, and the fact that Kumar Mangalam Birla himself was there and was the first speaker and was speaking with so much confidence in his body language. I think that's a very interesting Vodafone idea. Even the SBI chairman was there at the listing. Heavy demand from QIBs and HNIs. Let's see, retail got full allotment, so maybe some of them sell today. But my sense is it will get absorbed. The stock's out of F&O ban as well on expiry day. Now coming to the third big event, which is the Nifty expiry, and you have the April series expiry today. You have big support at 22. The range is 22,275 to 22,466. 10 and 20 DEMA placed at 22,325. That's the first support zone, around 22,275 to 22,325. And then the bigger support at the 50-day exponential moving average of 22,150. I think on the upside, keep an eye on 22,476, yesterday's high, and 22,525, going by the options range. On the bank nifty, as I said, today we need to see the balancing factor of Kotak Mahindra Bank and Axis Bank. X of that, the first support is at 48,000, near yesterday's low, and then 47,760 to 47,870, the 10 and 20-day exponential moving average. On the upside, 48,250 to 48,300 has been some kind of congestion zone, and then 48,500 to 48,600 is the bigger congestion zone. I'll leave you with quote of the day, and this one comes from Picasso. Everything you can imagine is real.
All right, interesting. Anuj, thanks very much for that, and good to get that set up from you as always. We'll take a quick commercial break here. We are back. Our technical trading experts are going to be with us, tell you what to do specifically on the indices and stocks as well. Mitesh and Sudarshan join us in just a bit. Welcome back. As promised, our technical experts are with us. Mitesh Thakkar and Sudarshan Sukhani join in to tell you what's the setup and how to trade this. Gentlemen, good morning. Great to have both of you as always. Mitesh, down about 50. That's the implied open this morning. The index has kind of lost a little bit of momentum, I reckon, right? Last 2 days showed a flash and then ended flattish to only marginally higher. So on the Nifty, Bank Nifty, what's the trade?
Prashant, we've been avoiding the index for the last couple of days purely because of the fact that while we had a good reversal from the lows of 21,800, I think there was lack of, strength in the momentum indicators to suggest that we'll fill this Monday's gap immediately and get past 22,500. So the idea was to reduce your long exposure on the index around these levels. I think that's played out nicely. Today's gap down could be interesting. There's some intraday minor support coming in around levels of 22,300. So if we get opening around 22,350, 340, I think you might want to see if there is no follow through on the selling side, then you might want to take a long trade. But till we get past 22,500, I think then it's only then that the bigger breakout will take place. So till then, I think it will not be a market where you would want to trade the index, but look at and explore the ideas on the breadth side.
Sudarshan Sukhani is also with us. Sudarshan, we've been talking about this ad nauseum, about how this is a very strong market we have on our hand. But you tell us, which way do you think it's heading? Do you think this uptrend is intact? And while you're at it, tell us about individual stocks as well.
Sure. See, good morning. The uptrend is intact. But after a big up move, the Nifty enters into a consolidation. For the last 3 days, I have said take intraday trades. And these trades I have suggested should be only on the long side of the market, keeping in tune the primary uptrend and even the short-term uptrend. But they should be intraday because carry-forward trades can cause problems. That view continues for today. If wherever we open, a sharp 50-point dip from the opening price on the downside justifies an intraday trade with a tight stop loss, only on the long side. Now, ACC is a buying opportunity with a stop under 23.70. It had a big day yesterday. Bajaj Auto is an intraday short. Remember, only intraday with a stop above 9,200. Torrent Pharma is another buying opportunity with a stop under 25.40. And finally, Dr. Lal Pathlab changed its trend from a down to an uptrend. Maybe it's a buy, stop under 21.60.
Mitesh, what about you?
Yeah. I have a mix of buy and sell calls. On the buying side is Ambuja Cement with a stop at 634. Look for targets of 670. Hindalco also, I look for a target of 670 while this recommended stop is 620. And on the selling side is Adani Enterprises with a stop at 3085 for targets of 2950. And Bosch Limited is a sell with a stop at 29,150 for targets of 28,200.
Okay, all right. Just a few movers from yesterday. United Breweries, Mitesh, I don't know if you have a trade or a view. And then metals, which moved very sharply higher, SAIL, etc.
See, I think I like the metals pack a lot. There is good price pattern being formed over there. So I like Hindalco, I like SAIL, etc. UB, I'm not, unfortunately, I haven't had a view, so I'll pass it out. But for the timing, I think metals can be a good trade to look at.
Okay, all right, gentlemen, we'll leave it there for now. Thanks very much, Mitesh and Sudarshan, for that. We take a break. We're back. The pre-open will be with us, and we'll all be discussing the first management earnings. So DCB Bank's outgoing managing director and the new incoming CEO and MD will be with us, both of them, to discuss the fourth quarter numbers and look into FY25. Stay tuned.
All right, welcome back. Let's do one thing. Let's go straight across to talk about the F&O market. Now, Chandan Taparia is joining in. He's a derivative and technical analyst of Motilal Oswal Financial Services. Chandan, hi, good morning. It's been a very strong market. So how are you feeling about it? What are the levels to look at and what are the stocks you're watching today?
Good morning, Sonia. Thanks for having me. So just a couple of days back, Nifty witnessed recovery from 21,777. It completed its 50% and 61.8% retracement, and now the momentum is missing. The good part is we have seen a decline in India VIX. The volatility is now near 10.3 and put call ratio is holding well above 1. So lower volatility with comfortable put call ratio indicate the declines could be bought. So overall, not expecting major momentum, but market is likely to be in a broader range with buy on decline stance. So as of now, we believe that 22,222 is likely to act as an immediate support, and with this support, any small decline could be bought for an upside move towards 22,600 zone. Talking about Bank Nifty Index, on last trading session, it formed an inside bar, but supports are intact. Major support is at 47,777, and with this support, banking index has potential to move towards 48,500 to 48,750 level. Now, talking about stock wise, first that is buy on Hindalco. We have seen good momentum in most of the metal name, and most of these stocks are adding built up of long position, and rollovers are also turning in the bullish side. The stock is making higher top, higher bottom on the daily and the weekly scale, and consolidation breakout is clearly visible after the 6th trading session, holding well above 620. So Hindalco is the first trade on metal space. We buy with support of 622 and expecting move to our 658. Second trading area, that is buy on HL. Most of the defense stocks are doing well, whether we talk about FNO and non-FNO. HL is one of our preferred name, and we have recommended multiple times. Still, we believe that 8 to 10% rally could be seen in the counter. It has been making high top, high bottom. Strength is clearly visible in the entire space with built up of long position. So recommending to buy on HL, Hindustan Aeronautics, with support of 3860 and expecting a move towards 4120 zone. Last trading idea, that is buy on Concor. We have seen buying interest in selective railway counter. So Concor is one of the strongest name where we have seen a positive price pattern, which is cup and handle, which has bullish implication. So recommending to buy Concor with support of 950, and stock can head towards 1010, 1020 levels.
Okay, Chandan, thanks so much for joining in. Wishing you a good trading session ahead. Well, let's get back to Deepan Mehta. Deepan, final question before we let you go. What about Dalmia Bharat? You didn't like any of these cement companies, but the stock is opening up lower. It's already down 20%. 20-25% lower. Do you like it, or will you still avoid?
No, Nigel, I would still avoid cement at this point of time. And I think the competitive spirit and the way the capacities have been enhanced, all those dynamics are coming into play over here, where volumes have been good, but because of lower pricing, these companies are going to have reporting profits which are lower perhaps. And look, on the other hand, also fuel costs are going up for them. So I think they get into very tricky territory, all the cement companies at this point of time.
Okay, well, let's do one thing. Let's talk about DCB Bank now. That's the first management on the show. It reported a very strong set of numbers. The asset quality was the best in 4 quarters. Overall, the business momentum was strong. We have Murli Natarajan, the outgoing Managing Director and Chief Executive Officer at DCB Bank, and Praveen Kutty, the incoming MD and the CEO of the bank, who join in now. Gentlemen, morning to both of you, and thank you so much for being a part of this discussion. Mr. Natarajan, I wanted to start with you first, right? Very strong quarter. Of course, as you leave, things are getting better and better for the industry and for your own business as well. So wanted your understanding of how things are going to progress from here. What kind of growth do you see in FY25 for the bank? And what do you think the big triggers could be for the banking sector?
So I would like to say that till 2020, if you have been tracking our performance, we have been doubling our balance sheet every 3.5 years. Then for about 12 to 18 months during COVID, the things slowed down, primarily because we are focused on small ticket, self-employed SME, MSME segment. And you know what kind of disruptions was caused to this segment during COVID-19. Once the clouds of COVID-19 started to clear, we put the bank back on the same kind of track. And this year we have grown almost 20%. So the way we see it is the kind of capacity that we are putting in, the kind of technology improvements we are doing, the kind of product innovation we are doing. We believe that we should be able to continue to build this bank, doubling every 3 to 3.5 years. And as far as the banking industry is concerned, I'm not, I can't give you that much information on that. But what I can say is that post-COVID-19, last 2 years, we have noticed that the segment that we are working on, MSME, SME segment, continues to be very, very promising and large.
Okay, fair enough. Praveen, I want you to come in on this because I guess you'll have a better sense of, which way things are headed in terms of growth, right? Deposit growth has been very strong in the quarter gone by, almost about 20%. Is this the kind of momentum that is sustainable even in FY25?
See, as a bank, we always focus on deposits first. We grew by 19.68% YOY in a year where liquidity was tight in patches. So we are very focused on the deposit franchise and the granularity of the deposit franchise. It's not just the volume by itself, but it's also the quality of the base that we have. So we continue to focus on it. I think the market is large. With innovative products coming in, DCB Bank has got a couple of very, very unique first in the industry and best in the industry products on the deposit side. Plus the digital movement that is happening across the industry and partnerships that we have. There has been a big needle movement, and I believe that it would continue in the future as well.
Also, Sonia, if I might just add,
Sure.
recently we are now enabled for GST and CBDT from our branches and internet. So all of a sudden, because it's now the platform is open for most banks, so we are part of it. So therefore, customers don't have to go to some other bank to pay their taxes. These kind of nuances and changes and innovation and enablement starts to really help us to build our deposit base.
Absolutely, and it doesn't show every quarter, but it works in the background. Mr. Kuti and Mr. Natarajan, good morning. Thanks very much. Prashant here. Praveen, if I can come to you, what's the road to a 1% return on assets looking like? And a sustainable one at that. Just give us some sense.
So the way we are looking at it is that from a NIM perspective, we should be around between 365 to 375% of the average assets. The fee will inch towards 1%. On a cost to average asset over a period of time, we intend to get to a range of about 2.5%. And credit costs, while currently the last quarter was at 0.16, it will settle. The model assumes that it will settle around 0.3, 30 bips. That's the way it would work. And from a time frame sense, we intend to get there in about 3 to 4 quarters time.
1% ROA in 3 to 4 quarters, basically, by the end of this, beginning of FY26 maybe.
Right.
Got it.
Yeah.
Thank
On
you.
a steady state basis.
Okay, all right. Hi, gentlemen. Good morning and good to see you all in. Well, I wanted to focus a little bit more on the asset quality.
Good morning.
Now, your slippage ratio has come down a little bit, but it continues to remain above the 3% mark. What's the outlook on that front? And out of your total restructured book, how much of it could, say, slip?
So, as far as our book is concerned, there's a reasonable component of gold loan which goes into NPA, and the subsequent recovery happens in the subsequent quarter, which is also the reason why you will see our upgrades and recovery is 95% of the slippage. So we're not overly worried about the slippage as such because the recovery and upgrades are strong. And the second part is within the recovery, the upgrade is significantly higher, which means the customer continues to bank with us, continues to be an income earning asset for us, and it's not a closure of the NPA through sale of asset where the customer stops being a customer. So the model has a slightly higher slippage ratio, but equally importantly, it has got a more than slightly higher recovery ratio as well.
See, but look at the margin of safety. We call margin of safety as income minus cost, which is the operating profit, divided by the provision. Till about 2020, you would see that we would have been like 4 times, maybe 4.5 times. And it just tells you that the robustness of our portfolio quality, that once we made the provisions that are required during the COVID time, we are finding the recoveries and upgrades coming through as the business is bouncing back. And we are back to a very strong margin of safety, which gives you the comfort that we are dealing with a very, very good quality portfolio.
Okay, all right. Just one more question. How much of your total book is unsecured? You know, I've seen the RBI wrap the knuckles on a lot of other banks. Just want to understand what is that number and how is it growing?
Well, we have a small MFI portfolio, which is unsecured. Otherwise, most of the assets is secured by hard collateral, and a significant portion of the hard collateral is self-occupied residential property. So our mortgage book, which is 54% of the entire assets, is obviously backed by collateral. Our SME book is also backed by collateral. gold is a pledge anyways. A large portion of a corporate book, which is a very small book by nature, is also fully collateralized. So the extent of unsecured loans would be, in high single digit or slightly low teens.
And also, we don't have credit cards and we don't have unsecured personal loans. I mean, if you have some unsecured personal loans, it may be in some kind of a PTC or a DA that we would have done some transaction. Other than that, we don't have those loans.
All right, we will leave it at that. Gentlemen, thank you for taking time out in the morning and chatting with us about DCB Bank. Have a great day, Mr. Natarajan as well as Praveen. That's DCB Bank, strong set of numbers. But let's get back to the market. Looks like it's going to be, a slightly lower opening, down about 80 odd points in pre-opening. Let's kick off the stock-specific conversation with Sudarshan Sukhani is back with us. Sudarshan, what's the call at 9:10?
Consider buying ACC with a stop under 2370.
And Mitesh, what about you?
I'll go with a buy on Ambuja Cement with a stop at 634 for targets of 670.
Okay, Nimesh is with us to tell us the standout brokerage report of the day. Nimesh, over to you.
Hi, Sonia. So today's standout is on Bharat Forge, a double upgrade from BofA Securities. So today they've upgraded the stock to buy from underperform, and they've raised the target price sharply to 1450 versus 1000 earlier. Now they say that they expect US truck down cycle to be very short-lived, shallow, and priced in as well. In fact, they're not seeing any softness in the production yet, and the freight indicators have bottomed out. They see the new wheels of growth coming in largely from the defense sector, which is going to see a big momentum in terms of increasing revenues. They see PV exports to on a high, and also the industrial casting business to improve from year on. In fact, the stocks actually underperformed Y2D both in terms of global as well as local peers, and that BofA believes that it makes the risk reward pretty much favorable in case of Bharat Forge. In fact, they're expecting a 20% EBITDA CAGR and a 40% plus EPS CAGR between FY 24 and 26. So a double upgrade on Bharat Forge from BofA Securities, and target price now raised to 1450.
We'll keep an eye on that one. Nimesh, thanks a lot for that. Well, Abhishek joins us to talk about the stock of the morning, Kotak Mahindra Bank. Abhishek.
Well, Nigel, RBI has taken action against Kotak Mahindra Bank. So it has asked Kotak Mahindra Bank to stop issuing new credit cards as well as onboard new customers on their online and digital platforms. So credit card portfolio as on Q3 FY24 grew by 52% YOY and 10% quarter on quarter. As of March, as per RBI data, the total cards were at 59.54 lakh for Kotak Mahindra Bank. The market share of that being at 5.85%. In terms of spend, their market share is 4.44%. Average spend is about 12,299 rupees, which compares to industry average of close to 16,200 rupees. If you take a look at the peer comparison, Kotak Mahindra Bank in terms of cards market share is the fifth highest or fifth largest player, and in terms of spends, the market share is also the fifth largest. How has March been for Kotak Mahindra Bank? As per RBI data, the spends have grown 19.6% month on month. When you compare March to February, cards are down by 1.5% month on month, and spends are up 21.35% on a month on month. So a profitable business getting impacted. Citi has written that 90% of new investment and 76% of FDRD, that is fixed deposit, recurring deposits accounts, were opened digitally. Back to you.
Thanks.
All right. 10% lower, 1665. Abhishek, thank you very much for that. So that is Kotak Mahindra Bank with a big knock, which we are seeing. 85 points lower at the end of the pre-open session, and a minute to go, less than a minute to go for the market open. Second actually was the first trades. The Nifty and the sensex will come up. 23,300 is where we are at. 73,615. These are first rates which are coming through for both those indices. The bank Nifty is down 1/3%. Large part, I'm assuming the substantial portion of the cut that we're seeing on the Nifty bank is, of course, all Kotak Mahindra Bank. Axis should be pulling in the other direction. The new shares in Vodafone Idea being listed today, and the first trades on that also we'll have up on the screen. Mid and small caps as indices have been pretty strong over the last couple of days, and we'll see where they go as well. Vodafone is starting under 13 rupees, 12.6 or so is where we're at. Mid caps are flat, and I think the small cap index is also starting out absolutely flat. But Sonia is here with more rates. Sonia.
Well, thanks a lot for that. I want to start off with Axis Bank, right? Because over there, I think there's some amount of support that we're getting from Axis Bank this morning. Look at that, 3% higher now. The core revenue, the asset quality has definitely surprised. The loan growth is very healthy at 14%. So that's something the street has liked. Kotak Mahindra Bank is the one that sort of, it's really under a lot of pressure right now. So 9% knockdown on Kotak Mahindra Bank this morning, down almost 170 odd points. If you've joined in late, the RBI has asked Kotak Mahindra Bank to stop issuing new credit cards and onboarding new customers through its online and mobile banking channels. Another stock that perhaps could be under pressure and has been for a while is HUL. So that one is down almost 1.5% right now. And that, I think, is also, some of these stocks are also dragging the advanced decline ratio because of the performance that we've seen. Well, LTI Mindtree has been a disappointing set of numbers as well. Look at that, 2% lower. So we have lots of numbers that have disappointed the street today. Indian Hotels on the flip side, though, has been a very strong set of numbers. Best quarter four ever. Revenues are up 17%. Margins are up nearly 200 basis points. But this is a stock that has rallied substantially in the last 6 to 8 months. So that's something to keep in mind as well. Apart from that, you have Singen, which is at a multi-quarter high. The earnings have improved for Singen. The stock is just a bit lackluster this morning. Macrotech Developers, real estate has come back into action in a huge way. So almost 2.5% higher on Macrotech Developers, almost inching towards that 1,300 rupee mark now. Strong guidance, they're expecting a 20% growth going forward. Now, today you have a whole host of numbers that will come out. There's ACC, Tech Mahindra, Bajaj Finance, IndusInd Bank that all will be reporting their earnings. So we're just going to get the stocks one by one to show you what the street is looking at ahead of their numbers. Some acquisitions as well. Happiest Mind will acquire Pure Software Tech, so keep an eye out on that. And our colleague Nimesh just told us about Bharat Forge, so I want to get that stock up on board. Look at it, 4% higher now. There's a double upgrade that has come in from BofA Securities with a target price of 1450, which is a big upside to the current market price. So all in all, you'd have to say the market, the sensex is now just below that 74,000 mark. The nifty just hanging at 22,350. Not a bad opening, you'd have to say. Given the kind of run-up that this market has seen, this is just a bit of consolidation. Back to you.
All right, Sonia, thanks a lot for that. Well, I'm focusing on a couple of more banking names. MAS Financial, Abhishek told us those numbers were super. The stock is up close to around 5%. So big up move is what we're seeing out there. DCB Bank, we just spoke to the management. They're sounding very, very confident. They're saying they're doubling their asset book in the last few years. And in the next 3.5 years, they're expecting it to double. Margins as well at around 3.65 to around 3.7%. And the return ratio, well, they're expecting to go to around 1% in the next 3 to 4 quarters. So the street likes those numbers. That's building on to the gains. Abhishek sends us another important point in terms of market capitalization. He says that Axis Bank market cap is now higher than Kotak Mahindra Bank because both those two are moving in opposite directions. So just keep an eye out on that stock. Moil, yesterday the stock traded well in the green today as well. It's building on to those gains. So good going out there. Sterlite Technologies, one of those other stocks that are trading with very, very high volumes. So keep an eye out on that one as well, moving higher in the initial few minutes of trade. And some of these sugar stocks as well are coming back in favor. You have Sri Renuka Industries, that's up close to around 3.5%. It's coming up as one of the top volume movers, so that's why highlighting that name. On the flip side, NMDC Steel, well, that stock is under some pressure. It's down close to around 1%. One of the top volume movers in today's trading session as well. CSB Bank as well, building on gains up 2.5%. Indian Hotels, numbers look good, but the stock comes in for profit taking. And as we mentioned earlier, Dalmia Bharat, well, the street was positioned for weak numbers. The stock opened up with a cut of around 4%. Now it's down just around 1.5%. So some bit of short covering is what we're seeing on that name. Prashant.
No, absolutely. Pull up the Nifty, which is down 60 points. So, it's neither here nor there kind of a start. It's lower, but, just 1/3% or so. That's about it. So not really anything very large. Kotak, of course, is the big drag. 10%, 1660 or so is where Kotak Bank is at. Just look at Idea, right? Those shares got listed. The low today on Idea is 11 rupees and 80 paisa. And it's basically moved a full 1 rupee from the lows of the day. And now getting back to almost about 13 rupees. So that initial, actually, of course, yesterday it was down about 9.5%. A lot of the ARB guys, etc., would have sold in yesterday and this morning. I'm assuming this morning. Volumes are very, very, of course, large with these new shares which are coming through. So that's the picture on Idea. Lots of interest around this one. Look at that on Idea. Big recovery from the lows of the day. It's a very strong, big green candle. Nimesh was telling us about Bharat Forge, right? The double upgrade, 1,400 plus kind of price target from Bank of America. It's Bharat Forge is the second biggest volume-led gainer for about 500,000 shares now. So stocks are up 3.6, 3.7%. BSC, day before yesterday, it had a massive 10% move. Yesterday cooled off. It's up another 1.5% right now. Nippon India Mutual Fund is up about 4%. Again, very large volume. Stocks at about 606, 607. Okay, Mr. Birla is speaking. Let's cut across.
So much. Indus Towers stake. Any word on that? Whether
Nothing just now. There's no definitive path that we've charted out just now.
all right, Mr. Birla, many congratulations on this big fundraise. Do you think that most of the problems of Vodafone Idea that the group had been struggling with over many years, that is sorted for the next few years with this issuance?
I think so. I mean, without a doubt, right? I mean, we've been in the sector for 2.5 decades now, which shows our commitment to the sector and to digital India.
Yes.
And this is, like I said, a fresh lease of life for the company.
And what about Industar stake sale? Do you have an arrangement with Vodafone PLC that the entire amount of their stake sale proceeds will be infused in this listed company?
Well, not really, but, we're going to see as it comes. So nothing specific at this point.
As per the arrangement, what percentage is there?
I think we are not talking about
Yes.
this.
Yeah.
All right, and the government stake sale, is there any indication on that at any point to monetize?
We're not talking about stake sale at all.
At some point they would like to monetize it. Do we have any understanding?
I think you are jumping many guns. I don't think that's the plan at all as of now. Okay.
All right. Thank you. Thank you.
Short and sweet. Our colleague Nisha Podar taking those questions to putting that questions to Mr. Birla. And of course, what he said at the bottom of the screen, fresh lease of life for the company. That is Vodafone Idea. In terms of what the government may do with their stake later on in terms of monetization, etc. Nothing on the annual, at least right now. And, this is looking good. Stocks, of course, also come up quite a bit nicely from the day's lowest point. I was talking about stocks. Moil is up another 2%. Nigel was highlighting this name yesterday. It was up 2.5% yesterday, another 2% this morning. Sterlite Tech is up about 4%. It's got strong volumes as well. And something like a Z has come up, right? Z is up about 2%. Stock's 143, but then it's come to 143, 145 many a times and then sold off. So we'll see if this move is here to stay. What else? In the broader market, I think this is about it for now. I think the others we mentioned, Tata Consumer is down another 2% right now, 1,089 right now. Titan is down about 1%. On the downside, AG's Logistics, which has had such a large rally recently, that's starting about 1.25% lower. And there is something like a Phoenix Limited, which is down about 3.5%, 4%. So stocks at about 3072, and it's got volumes to go for it right at the word go. Our market master of the day is with us. Gautam Shah is founder and chief strategist at Goldilocks Premium Research. Gautam, good morning. Good to have you with us here. Thanks very much. We seem to be in a bit of a waiting room, Gautam, waiting for the next move, up or down. And the index over the last couple of days seems to have also quietened down, although from the lows, we got a 1,000-point move up and then a 1,000-point down move, and we've retraced that quite nicely. Where does it leave us? I'm talking about the near term, next 1.5 odd month, because in this time frame, you'll also have the election results. Gautam.
Good morning, Prashant. Well, I think the waiting room is much better off than going downhill. I think that's something which people would not mind. And it's just not been the last few days. It's actually been the last 4 months. Because we've been in this, band of about 1,000 points. We've oscillated between greed and fear. 22,300 has been a sort of a marker number. We go 500 points above that. We go 500 points below that, and there is no follow-up. But I think this is just quality consolidation that has taken place. The market is showing a lot of maturity. And the way we have handled two major geopolitical developments in the last 5 to 6 months, it just tells you that this domestic liquidity angle is really bailing out the market every single time. So I just see this as consolidation. I think the problem is there is no real leadership because banks are not doing well. Reliance is unable to get past 3,000. The IT index hasn't been able to do well. But I think the comeback in the last 1 week tells me that the market breadth is back because in general, themes have done well, stocks have done well, but the indices have not gone anywhere. And I think once we get past 22,500, 22,800, which I think will eventually happen, then possibly you'll see the next 5-6% move. But the trade is still not about the Nifty and the Bank Nifty. Stay with the outperforming sectors, and I think there is still a lot of money to be made.
Oh, yeah, absolutely, no doubt. Pull up UBL. I just want to make a quick mention before I toss it to Sonia. UBL is up another 3%. You know, it was a big mover yesterday. We were discussing this with our technical analyst in the morning, and Deepan as well. So another 47.50 rupees coming through there, 20.78 on that, backed by volumes as well. Sonia.
It's hot, right? I mean, this summers, the demand just goes up across the board, right, for stocks like UBL. But Gautam, hi, good morning, and thanks for joining in. You know, this is a out-and-out bull market, right, we're looking at. We haven't got any major dip in the last 1 year. It's climbed every wall of worry, as you just said so yourself. So what do you do now? Do you continue to buy, hoping that as we head into election season, as perhaps, you know, the incumbent government comes back to power for the third time, do you think that will give a fresh lease of life to this market? Or are you starting to get a bit cautious at these levels?
Well, I think it's a bull market where you don't need to overanalyze. I think you just need to stay in the bus and not thinking about getting off on every single correction that happens from time to time. And I think all of us pretty much agree that election is in some sense a non-event. So in that sense, I don't think the market is very excited or worried about it. I think we're just going through the motions over the next 4 to 6 weeks. And whatever the outcome, I mean, we pretty much have some sense. I think the markets should be okay. So that might not be a big trigger. I think the big trigger is really going to be earnings and whether the Indian markets can actually, you know, deliver on the fundamentals, because, you know, we've really run ahead of ourselves in the last couple of months. But I do believe that, you know, if you compare with the last bull market, wherein you routinely saw corrections of 10 to 15%, 5% has become the normal 15%. So in that sense, I think this shakeout, internal rotational shakeout that happens from time to time just makes the market healthy. So stay with the right pockets. I think the index is safe till we are above 22,800. Until that number is safe, I think long-term investors should just, you know, look at this market and stay with this market going forward.
Okay, all right. Hi, Gautam. Just hold on to that thought. You know, I want to focus on Tata Chemicals. China's soda ash prices are up by close to around 5% today. So that could be the stock on the radar. For the time being, it's trading with some mild gains, but just keep an eye on that one. Tata Chemicals is the stock that we're talking about. Soda ash prices up 5% today. Sometimes in the near term, it does have some kind of impact as well. Well, Gautam, I wanted your view on a couple of these big movers. You know, particularly in today's trading session, we have fundamental news that's putting pressure on Kotak Mahindra Bank. And the stock is down close to 10%. But otherwise, it's been an underperformer as it is. You know, on the charts, how's it looking? At some point of time, value will emerge. It trades at around 2.5 times price to book. So there could be some derating. But fundamentals aside, technically, how's that one looking?
You know, Nigel, the market knows best. I think whenever I've spoken to a lot of HNIs and corporates, I think the key takeaway is that Kotak as a stock hasn't done anything in the last 2 years. In fact, it's been a bigger underperformer than even HDFC Bank that we talk about. I think in some sense, the market knew that there was a problem somewhere, and probably the news is now out of the way with what has happened in the last couple of days. But, you know, this is a market where you don't touch underperformers because then you don't generate alpha in your portfolio. And as you know, we've been a very big bull on SBI, and we continue to believe that that is the banking stock you need to focus on for the rest of the year. But otherwise, you know, all other banking stocks, I think stay away, because the bank nifty also seems to be in a range of about 46,000, 48,500. Until we don't get past the range, I don't think you're going to see any fireworks in the banking space. So SBI in the PSU names and ICICI in the private names are the two banks we are betting on. But I do believe that metals is still the trade of the year. I think I spoke about it in the last interaction as well, and it's had a fabulous run. I think this is going to continue.
Gautam, so where is the momentum? Where is money going to be made? Give us ideas.
Yeah, so I think there are three themes that we like. Metals, as I said, I spoke about it last time. I think this is a structural trend. A lot of people whom I speak to are unable to join the dots from a technical and fundamental standpoint, but now the fundamental triggers are gradually coming in. And you've had amazing moves in stocks like JSPL, Vedanta that we covered recently, Hindalco, Nalco. SAIL has been a favorite, and I do see that stock doing very special things over the next 6 to 12 months. So I think the metals index is set for another 10 to 15% upside for sure. The other high conviction idea that we have is chemicals. I think that's a space that has come back strongly in the last few days. SRF, Tata Chemical, Deepak Nitrate, Aarti Industries, all very good stories coming out of 2.5 years of consolidation. So metals, chemicals, pharma, and select banks and select PSUs are the spaces that we like.
Chemicals, are they out of the woods, you think? or this is a turnaround bet. When you look at technicals, I mean, you're supposed to bet on sure things, right? So when you're saying that you like it, I mean, I'm assuming it's turned the corner.
Yes, Prashant, I think the way we do our technical analysis, it's not just views, it's commitment. And I think we are committed into chemicals because we feel that this time is indeed a genuine breakout. So I do see a 10 to 15% move on the entire chemicals index, which is a custom index that we prepare at Goldilocks. And some of the top stocks that I highlighted, I think could do special things. It's just that they were the poster boys in 2020, 2021, lost their way, went through a large correction. Now coming back, there is a lot of tailwind fundamentally as well. And given the China factor, I think there are feelers on the charts that the uptrend, which started in 2020, is now resuming. So all the top quality stocks in chemicals should do well over the next 6 to 12 months.
Got it. You were bullish on the auto sector for the longest time, and that is a space that has done really very well. But I don't see it in your bullish list anymore. Do you think the run is done there?
Yeah, I think auto and real estate were our favorites, a year back, and they did very well for us. And now I think we've come to a point where a risk reward does not justify taking aggressive bets in the auto space, whether it's an M&M or a Tata Motors where the story is played out. But there are two stocks that we like and we actually recommended recently to our clients, and that is Eicher Motors and Escorts. And I think these two stocks could do special things along with Maruti, which seems to have now got into 5 figures comfortably. It was toying with that 10,000 level for a very long period of time. And now that becomes a base. So these three names in the auto space, I think could generate alpha for your viewers over the next 6 to 12 months.
Gautam, when I asked you about chemicals, the only reason I'm asking is because it's one of the few spaces which is underperformed, right? So when you put out that call on chemicals, it's not just people who are chartically inclined who are going to be listening to you. It's also going to be the value guys, the fundamental guys who are going to try and match their views in terms of what the turn is and what you're seeing on the prices. So good to get that. Thank you very much, Gautam. Good chat as always, and appreciate your time here on CNBC-TV18. The market's down about 60 points. We're at about 22,345. But we're going to talk about real estate, Nigel.
Well, let's get straight to that then. You have Macrotech Developers that reported a very, very good set of numbers. The stock, in fact, was trading higher. It's come off the high point of the day. But FY24 was an absolute stunner for them. What's the outlook with regard to FY25? We have Mr. Abhishek Lodha, the MD and CEO of Macrotech Developers, who joins us on the show. Hi, Abhishek. Good morning and good to see you in. Well, you're looking at a pre-sales turnover of closer around 17,500 crores for the next fiscal. That's FY25. Break it up for us. What is the launch pipeline looking like? You had price increases in the past year of closer around 5%. So how much of this growth will come in because of price increases? And what should the volume number look like in FY25 in comparison to FY24?
Good morning. Very good to be with you. We closed FY24 in line with our projection for 20% growth and grew a little over 20% to pre-sales of 14,500 crores. And our embedded EBITDA margins were at about 31%. We as a company are striving to ensure that we have predictable growth and we have profitable growth. And both those parameters are very important for us. For fiscal 25, our guidance is for another approximately 20% growth in pre-sales, bringing us to about 17,500 crores of pre-sales and an embedded EBITDA margin of about 31%. In terms of the mix of the pre-sales and pre-sales growth, we're looking at price growth to continue to remain below wage growth because that's consistently being our effort to make sure that affordability keeps getting better and more Indian families can afford to buy a high quality home. So we're looking at about 5 to 6% price growth for the coming fiscal and the balance 15% coming from volume growth. The volume growth can again be broken down into two parts. Volume growth from existing locations, which will be somewhere around 4 to 5%, and the balance 10% will come from volume growth from new locations.
Okay. I want to understand, since you said new locations, Abhishek, I'm going to take that forward, right? While most of the Bangalore-based players are rushing to come into the Mumbai markets, here you are taking your projects to the Bangalore area. I mean, 2 pilot projects have been kicked off in Bengaluru. So I want to ask you, how has the response been? Primarily because, there is a lot of talk about oversupply in the Bangalore markets and the fact that price hikes have not come along for a while. How are you looking to sort of navigate that space, and what is the kind of launches that you're looking at over the next 1 to 2 years?
Sonia, hi. When we talk about new locations, for us, new locations are not just new cities, but they are new locations within each city that we operate in also. Our broader thought process is that consumers in India typically like moving to a new location which is within 2 to 4 kilometers of their existing home, so that they don't disrupt their existing life, including education for kids, office commute, social network, and so on. So we continue to want to have more presence in the 3 cities that we are operating, which is Mumbai, Pune, and Bangalore. In Bangalore, we started off with 2 launches last year. Both of them were very, very successfully received. We did about 1,200 crores of pre-sales from Bangalore from these 2 launches. Our pricing was much higher than what one would call other competitors in the market, because we also, in our opinion, offer much superior product, are spending more on our construction, and therefore the consumer is getting better value. We like the Bangalore market because jobs are being created, wealth is being created, and there is a desire to have higher quality housing. And that's the same trend we've seen both in Mumbai as well as in Pune. So we do think that the Indian consumer is becoming more aware of the fact that the house plays a very, very important role in the quality of life that one lives, particularly because our urban infrastructure is not the greatest. And therefore, there is a growing desire to buy from the most reputed players and buying in higher quality projects.
Correct. It's interesting you say that apart from new cities, you're also looking at new micro markets within the same city, right? We were having this conversation with Boman Irani of Rustomji a couple of days ago, and he said that there's a lot of interest in some of these newer micro markets, whether it's something like a Versova, Chembur, Bandra East, some markets that you've never really thought of being luxury home markets. You guys are also looking at places like Pallava and Upper Thane. Of course, you've been there. But what are the other new micro markets that you're looking to target within the MMR region? And where do you see potential?
Sonia, like I mentioned, we want to be present like a supermarket is every 2 to 4 kilometers. Within every city that we operate in. Mumbai, of course, we are closer to that. And then in Pune and Bangalore, it will take us more time to reach that depth of being present every 2 to 4 kilometers, so that any consumer who wants to buy a home has a Lodha option which fits within his geographic preference. We don't think it's driven by having a luxury offering at every location. The offering has to be reasonably fit to the demands of the target audience in that location. Every product has to be high quality, and that's what really Lodha is known for and stands out for. But it can be across different price points.
Yeah, Abhishek, hi, good morning. For Pallava and Upper Thane, I think you've given some big targets, right? Total sales of between big numbers, 175 to 200 billion kind of numbers. But these are very long-term targets, 30 years down the line. Could you kind of tell us why targets with such a long time frame?
Hi, Prashant. Good to speak to you again. Pallava and Upper Thane are 2 large developments in the outskirts of Mumbai, are really a play for anybody who views India's long-term development. The reason we chose to look at the 30-year time frame, because the government has given, the Prime Minister has given a approximately 25-year time frame for India to become a developed nation. And we think that these 2 developments are a true blue-blooded play on India's development. Here we have land of about 600 million square feet of development potential. We have built the infrastructure. We have high quality of social infrastructure. The government's large infrastructure initiatives are all in that region. And we now have a situation where, in addition to mid-income and affordable housing, we are going to have premium housing come through in these locations. So while we, of course, have talked about what sales we will, on an aggregate basis, likely to generate over the next 3 decades, we are, of course, also breaking that down into what we expect to do, over the foreseeable near term and medium term. So that, of course, is all part of the overall thing. But we do need to take a view that, it's rarely in the aspect of development that you can get such long-term outlook and you can get such long-term visibility, which is one of the things which makes us stand apart as a company, is how we can have long-term visibility and long-term cash flows coming from these 2 very, very strategic locations.
And that is, got that, well put, Abhishek, and that is dollar billion. Is it, just to confirm those numbers?
Yes, that's US dollar billion at current exchange rates of one US dollar being 83 Indian rupees.
Okay, got that. Abhishek, you know, we're people who watch us usually look at whether you know, stock ideas. Let me ask you, since I have you and you're the best mind to ask you the best property idea. Of course, without saying, it's Loda. I'm assuming that's what you will say. But which are the micro markets in and around Mumbai where you think one can expect? I mean, where there is a structural kind of tailwind. If you can identify one or two, I think it'll be helpful for viewers. Even from an investment point of view, which are the best placed micro markets around Mumbai?
I think, Prashant, that's the beauty of housing, is that housing will give you consistent compounding and, you know, with very high tax efficiency for long durations of time without having the volatility which comes from some other asset classes. Today, even if you take conservative price growth of about 6%, when wage growth for the white-collar worker is more like 9-10%, and you take a rental yield which is about between 3 to 4%, you're getting housing without you needing to do anything special, giving you 10% total returns on an annualized basis, and it can be higher if price growth is higher. So you're talking about 10% returns, which are going to come through from any location that you buy housing. Just take care that it's a good location, good access, and you're buying from a reputed developer.
Which are those? I'm looking for value bets. Not in the stock market parlance, we say what is overpriced and what's the undiscovered gem. So I'm looking for undiscovered gems, not completely undiscovered, but relatively. Give us one or two micro markets.
Prashant, I'm sorry, I won't have that view because, I think that the best value is not created by paying, whatever the lowest entry price is by paying fair value for good product and allowing the compounding to take place over a reasonable period of time.
Okay, all right. We'll press next time, Abhishek. We're out of time. That's the only reason we're stopping. Thank you very much for joining us and running us through what you make of the real estate picture and sounding bullish, and of course a little bit about the F525 guidance as well. But I think from real estate to banking, Sonia.
Yes, real estate to banking. There's a lot, that we're talking about this morning. Equitas Small Finance Bank is the next management on the show. The asset quality continues to deteriorate. Q4 FY24 disbursements were also on the lower side year to year. P.N. Vasudevan, the MD and CEO of Equitas Small Finance Bank, is with us. Mr. Vasudevan, thanks a lot for joining in. Always good speaking with you. This asset quality deterioration is something I want to talk about because gross NPAs are at about 2.6%. What led to that? And if you can just tell us about what the way forward is, what's the target gross NPA by the end of FY25?
Yeah. Hi, good morning. I believe that Equitas, we have come back to the near normal level of the pre-COVID scenario in terms of our portfolio quality. If you look at the gross NPA between the third and the fourth quarter, it's gone up by about 14 basis points. Out of this 14 basis points, there was a one-time effect because, we had sought a clarification and RBI has clarified that in case of co-borrower, any agreement where a co-borrower becomes when an account becomes NP and there's a co-borrower in that account, and then any other agreement where the co-borrower is a borrower or a co-borrower, those also need to be classified as an NPA. That's something that we had got a clarification from RBI. And that had a one-time effect on the NPA because we did that in the month of March. So that came to about 10-11 basis points of that NPA. So out of a 14 basis points increase, about 10 to 11 has really come from that. So more or less, the GNPA otherwise has remained steady. And, pre-COVID also, our GNPA used to be around 2.5 to 2.6. And today, it currently continues to be at that same level. So I believe that more or less, we are back to our normal levels.
Back to your normal levels would be what? What is the gross NPA that you're targeting by the end of FY25? And where do you see incremental stress coming into the book? And if yes, where from?
Yeah, so we expect that our GNPA should be at the same levels, 2.5 to 2.6 is where we should expect for FY25. And none of the portfolio segments where we operate are showing any particular stress level. So I don't think we are really having any concern on any particular segment. And this is a very much kind of a normal scenario for us.
Okay, all right. Hi, Mr. Vasudevan. Good morning and good to see you, Ben. Give us an outlook in terms of growth. What is the growth you are penciling in which segments will fire up that growth? And also, what about the NIMs? The NIMs, I think they're holding. There was a bit of a dip on a sequential basis. So where does it move from here on?
Yeah, so on advances growth, I think we have been consistent in our communication that we should be looking at around a 25% growth on a medium-term basis. So that's something that we are geared for, and we should be able to look at that going forward. In terms of NIM, yes, there has been a reduction through the year. We ended last year at 9%. That is 23 FI we ended at 9%. And 24 FY24, we are ending at about 8.16% for the quarter end. And for the full year, it is 8.35%. So there's been a drop. And that drop is largely because we had an increase in interest rate of nearly 90 basis points through the last year. And parallel to that, or simultaneous to that, we also did a lot of work on reducing our CD ratio. We started the last year at about 100%, and we ended the last year at about 87%. So that was a large amount of work we did. That's why you see our deposit grew by about 43% against an advance growth of 23%. So most of the impact of CD ratio and the interest cost repricing has been done in the last year. And so we believe that this year, that exit of 1.6% NIM that we exited at, we should be able to look at a NIM anywhere between 8.1 to 8.15% for this year.
Okay, all right. Okay. Give us some more clarity then. Credit costs going ahead, what should it look like? If you could give us a guidance for this year.
So last year, our credit cost was 1.01% on advances. And historically, our credit cost has been in the range of 1.2 to 1.25% on advances. That's been our normal experience all these years. And I think we are very close to that. So this year also, we should pencil in a credit cost on advances of anywhere between 1.2 to 1.25.
Okay. On the rural side, can you tell us any stress that you're seeing in terms of rural loans right now?
See, for us, microfinance, we have nearly about 40% of our book on the rural. The remaining 60 is largely semi-urban and urban. And outside of that, our commercial vehicles will have some presence in the rural. But otherwise, the remaining is largely on the urban and semi-urban. And in our own portfolio, actually, we don't see any difference in portfolio behavior between rural and semi-urban, urban.
Okay. And you have been shifting your focus away from NBFCs to some of the smaller businesses, right? What is the segment that's looking the best for you right now, and what's the outlook on growth?
So we used to finance NBFCs. We used to give loans to NBFCs earlier, but that's a very tactical stuff. We were sitting on 25-26% capital adequacy at a point in time, and the rates were also kind of giving us a decent return. But today, our capital adequacy has come down to 21.7%. So we are not really sitting on large surplus of capital to allocate to, all businesses. So we are trying to be prudent in our allocation. So NBFC, since it's not really a part of our strategy, it's just part of our tactical stuff. So we have just kind of slowed down on NBFC lending. And you should see more of that NBFC portfolio actually coming down over the next few quarters. But otherwise, our growth has been strong in all our other segments. Microfinance grew by about 20%, and the rest of the book grew by about 24%, giving us an overall growth of 23%. Our flagship program, of course, is our small business loans, which is almost 38% of our book, and that continues to do extremely well.
Okay, all right. Mr. Vasudevan, final question then before I let you go. You're saying that the cost of funds, that seems to be bottoming out. Your CD ratio is pretty much in check. What should the ROA look like? What is the target out there? That's point number one. And you've repeatedly mentioned, that your focus is on getting yourself tech savvy, and tech ready for the future. That will involve some cost as well. So what will the cost to income ratio look like? ROA and cost to income ratio. Please go ahead.
Yeah, so we expect a further about 8 to 10 basis points increase in our interest cost, by which time most of the old deposits should have got repriced. And so the cost of funds will kind of become a steady state after that. And our CD ratio, as I mentioned, we are at about 87, and we want to bring it down to 85 by March 25, which is a 2% over the rest of the year. So it will not have much of an impact on NIM this year, unlike last year. Because of this and the fact that our yield on advances, yield on disbursement has actually gone up by 1% over the last 1 year. At 18.75%, it's been going up over the last 1 year. And there'll be a lag effect of that on the advances. It takes about 2 quarters, 3 quarters for the advances to start showing that increase in yield. So a combination of all of this, we believe, should help us maintain our steady state ROA. Last year our ROA was 1.99%. I believe that we should be able to maintain that more or less going forward. And in terms of cost to income and our investment in technology, there are 3 areas we have been investing in technology. One is customer acquisition, second is customer experience, and third is internal controls. We are also spending a lot of money and a lot of technology being deployed to improve our internal controls and making it automatic straight through processing. And all of this we have put out in our presentation also. We are expecting to invest about 520 crores over a 3-year period on all these parameters. So we don't really expect our cost to income to dramatically come down. We will still be doing a lot of investments to build the bank for the future. So our cost to income, which is about 62% in the 4th quarter, should remain steady between 62 to 65% over for the next year also.
Mr. Vasudevan, cost of funds will go up before they flatten out, right? That's essentially what you said, 8 to 10 basis points.
Absolutely.
Okay, all right.
We still have some old deposits still maturing. So that will be a 8 to 10 basis points impact.
Good conversation, sir. Thank you very much for your time here on CNBC-TV18. Appreciate it. So that's Equita Small Finance Bank with some perspective and lots of numbers for FY25. We'll take a quick commercial break here. We'll have Renu Baid, the Vice President Research, IIFL Institutional Equities. We discuss trends in the capital goods space. Stay tuned. Welcome back. It's time for our special segment, Quarter Se Quarter Tak. We bring you earnings expectations from various sectors, and Vamakshi today is going to tell us how the setup for the capital goods space really is looking like. Vamakshi, over to you.
Well, absolutely. It has been a dream run for capital good companies so far. In fact, in the quarter ended March, on an average, the industry is expected to witness a nearly 16% growth in the revenues, and this will be supported by strong execution as well as record high order book across most of the companies. Cost saving measures as well as operational efficiencies could lead to a nearly 14% jump in the EBITDA. However, the margin outlook remains mixed. On the profitability front, however, a 17% jump on an average is expected across companies. Now, while the order flow has been robust in the recent quarters, a slight moderation is expected this time around, and that is mainly on account of the elections. Nonetheless, steady order inflows are projected in segments like renewable energy, power, transmission and distribution, as well as defense. Private investment has been selective so far, is also seeing some green shoots. So overall, the order momentum is expected to pick up meaningfully only after quarter 2 of FY25. Export orders, however, are a concern given the sluggishness in most geographies, geopolitical tensions, as well as trade disruption. Now, against this backdrop, all companies are forecasted to achieve double-digit revenue growth across the board, and on an average, this ranges between 13 to 25%. Margin projections vary. GE, T&D, Kirloskar Oil and ABB India are expected to witness expansion anywhere between 1 to 6% in their margins. BHEL, Siemens and to some extent Thermax, however, may see some pressure. With the exception of BHEL and CG Power, net profits are expected to climb for most of the companies. Now, in terms of stock performance, capital good companies have seen a very strong surge with returns exceeding nearly 75% across the board for all companies. In fact, on a year-to-date basis as well, the stocks have gained anywhere between 18% to an impressive 114% for some counters. However, this strong surge has in turn pushed current valuations above the historical averages, and the question still remains, can these premium valuations sustain? Will private capex drive the next leg of growth for these capital good companies? Well, only time will tell.
All right, thanks a lot for that. Renu Baid joins in. She's been tracking this space very closely for a long time. Renu, welcome to the show. In your coverage universe, which are the stocks that you're most bullish on this earnings season?
From an earnings perspective, this season, I think companies like Bharat Electronics, ABB, Cummins, data and small cap space companies like Data Patterns, and even EPC companies like KC Kalpataru from the lower base should bounce back strongly on the earnings side. But names like CG Power, Siemens and Thermax will just see barely single-digit growth in earnings. because of a very high base last year. So to that extent, we expect some moderation on the earnings side for some of the diversified industrials.
But for stocks like BHEL, just one follow-up there. I mean, they've rallied substantially, right, in the last 1 year. So do you see valuation headroom as well, or are you cautious because of the kind of rally we've seen?
We don't have a formal coverage on BHEL anymore. But yes, I think the rally primarily has been on the back of very strong reversion in terms of the order inflows for the thermal power. Execution, balance sheet repair is yet to be seen. So I think that is where one sees disconnect between valuations and the on-ground fundamental earnings outlook. So it's primarily linked to the revival of the thermal ordering cycle.
Renu, hi, morning, Prashant here. What is when you speak with investors, what do they want to see? Is it just order books which continue to grow? Is it now execution? Is it improvement in profitability? What is the real? I mean, if there is one dominating driver, which will drive share price performance from here for the sector?
The lead indicator for the sector has always been order inflows, and time and again investors look that as an anchor to peg their earnings outlook, forward earnings outlook. So I think order inflows have been the key. If I have to put one single catalyst, it's that. But it's just not order inflows. Investors also look for execution efficiencies, profitability. So the stock performances eventually are a factor of all of these elements. But yes, if it's one single element deciding factor, then it is order inflows as the headline number, as an indicator for future growth.
Okay, all right. Hi, Renu. Good morning. Nigel on this side. I had a two-part question. Since we get into elections, the government's order inflow could slow down a little bit. So are you bracing for a soft first half of the year and then a recovery in the second half of the year? So that's on the government spends, which actually has been very, very good. And on the other part of it, private capex is expected to pick up. Are you seeing green shoots?
So in terms of order flows, it's customary for election-related slowdown in order flows. That is already priced in terms of the assumptions for fourth quarter partially and for the first half of fiscal 25 across companies. So be it names like Larsen, where we have seen in the current fiscal almost 40% growth in the order inflows is expected. Next year, we are actually expecting a decline to flattish inflows for Larsen. Same for other companies, at least for the first 6 months, we're expecting flattish to marginal softness in order flows. On the private sector, also large ticket size greenfield projects, be it steel, cement, etc., could see some moderation in finalization during this election period. But nonetheless, towards the second half, we expect these to catch up. So I think overall, private sector has been holding up. The large ticket size orders from core sectors will see finalization in the second half of the current calendar year. Otherwise, I would broadly say the capex cycle should hold, and if government is able to execute well on certain reform activities in the power sector and key rolling stock ordering on the railway side, one will see a meaningful pickup in order flows in the next 2 years for the sector overall.
For Larsen, Renu, there was some news flow that the Saudis are lowering what they're going to spend on this new city, which they were building. I mean, some dramatic cuts. Of course, other development work, etc., in that part of the world is going on, but that was a single large. I think it was going to spend some $500 billion or something. At least that was a number which was put out. Is the pickup in Middle East as a large contributor a big reason for the share price performance we've seen recently, and is this a dampener?
For Larsen?
For Larsen, L&T.
Yes, as in for L&T, Saudi and hydrocarbons specifically have been one of the biggest driver for order flow growth in fiscal 24. And some of the news flows and announcements from if you look at Saudi Aramco, and even as a region to slightly consolidate the spending has been a bit of sentiment dampener. But practically from an order inflow perspective, because some of these projects and city development are long-drawn projects spread across 4 to 5 years. In terms of on-ground ordering activity, I don't think so there is much derailment. But yeah, the pace of order finalization and especially the current geopolitical tensions could add incremental risk elements to projects in the region there.
All right, Renu, we'll let you go on that note. Thanks a lot for joining in. Appreciate your time here. Let's slip into a quick break. On the other side of the break, we have the commodity discussion. Manisha Gupta joins in. She'll tell us all things commodities. Stay tuned.
Okay, we'll come back 10 o'clock and the market's doing, is come up nicely, right? Look at that, 10 points higher, 12 points higher on the Nifty right now. Maybe just put up the biggest damage there, which was Kotak Mahindra Bank, and see if there is anything there to kind of a recovery in Kotak Bank or elsewhere. Nothing at all, 10% lower, but maybe what was up is up a little bit more. So names like Axis, etc., perhaps also should come up on your screen. If anything, actually Kotak's now limit down, and it'll stay there for a while and then it'll open up. Mitesh is with us with what to do now as far as the index is concerned. Mitesh, so the morning dip, it's now in the flat terrain. Is there a trade in the index? You were saying in the morning you're avoiding index trades, but what would you want viewers to do?
I think we've not been trading the index for the last few days, but today, as I said, I think around 22,300 intraday averages, and you might get a bounce back. But the bigger trade will happen once you get a closing about 22,500. So if somebody's bought today, I think these are the levels to take profits, 22,400, 30, 50 zone, and then wait for the index to get past 22,500. On the stock side, I have a sell on SBI Life. I think that's a stock breaking down. So keep a stop at 1460 for target below 1400 here, and a buy on Axis Bank, which obviously with the numbers I think has opened with a gap up and given a good breakout. So Axis Bank is a buy with a stop at 1085 for targets of 1150.
All right. Well, since you're talking about Axis Bank, right, let me go across to Abhishek. He's joining in. Abhishek, what's the latest on Axis Bank?
Well, it was a beautiful quarter with respect to Q4 FY24 for Axis Bank, and records have galloped over there. Take a look at the gross NPA ratio. It's the lowest in last 34 quarters. Take a look at the net NPA ratio. It's perhaps the lowest that you are seeing in last 35 quarters. Now, net interest margin has actually expanded. There was a fear, or analyst estimated that, net interest margin will decline in this quarter by 9 basis point was the estimate by Morgan Stanley. However, the net interest margin has expanded 5 basis points sequentially, thanks to the domestic net interest margin, which actually grew by 8 basis points on a sequential basis. ROA has touched 2% for the first time that I am seeing for Axis Bank in last 9 years. ROE has crossed the 20% level for the first time that I am seeing in last 9 years. So annualized slippage ratio is at 1.44%, perhaps the lowest in last 14 quarters. Analysts were pegging that slippages will rise in the coming quarter, that is Q4 FY24, anywhere between 3,750 to 4,300 crore. However, slippages have declined. They have come down to 3,400 odd crores versus 3,715 crore in the previous quarter. CASA ratio has improved for the first time in last 3 quarters or 4 quarters, and PNL, both the ANA and PAT is a beat on our poll. PAT is also aided by other income. Back to you.
Thanks a lot for that, Abhishek. But the stock of the morning has to be Bharat Forge. And Nimesh joined us earlier to give us the top brokerage report. Nimesh, the stock is firing away. Tell us more.
Well, it's the biggest F&O gainer on the back of a big upgrade coming in from BofA Securities. So today they've upgraded the stock to buy from underperform, and they've raised the target price on Bharat Forge to 1450 versus 1000 earlier. Now, BofA expects US truck down cycle to be very short, shallow and priced in. In fact, they're not seeing any softness in production yet, and the freight indicators have also bottomed out. In fact, there will be new kickers of growth for Bharat Forge in terms of defense revenue going up, in terms of the PV export on a high, as well as the industrial casting business improving from year on. In fact, the stock has actually underperformed Y20 both in terms of local peers as well as global peers, and which is why the risk reward is stands out according to the BofA note. And they are forecasting an EBITDA growth of 20% and an EPS growth of 40% plus between FY24 and FY26 estimates. So a double upgrade on Bharat Forge by BofA Securities to a buy now with a target price of 1450.
Okay, thanks a lot for that. Well, let's go back to Abhishek. He's talking about MAS Financial. The stock is also buzzing in trade. Abhishek, over to you.
Well, consistency performance that you are seeing from a lender is MAS Financial since the time they have listed. So disbursements are up 15% YOY and 5.2% sequentially in Q4 FY24. AUM growth is robust at 25.1% YOY and about 4.7% sequentially. So the NII growth is 39% YOY and about 10.9% sequentially. It's perhaps one of the few lenders who has seen net interest margin expand both YOY and and quarter-on-quarter calculation shows that the net interest margin might have improved to 5.84% when compared to 5.26% in the same quarter last year and about 5.5% in the previous quarter. So PAT is grown at 22.7% YOY and about 9.1% sequentially. Asset quality slight hiccup over there. Gross NPA ratio has inched up by 2 basis points on a sequential basis. Back to you.
Okay, all right, Abhishek, thanks a lot for that. By the way, on the Nifty, from the lows of the day, we've recovered a good 100 points. You're making this point earlier today. Options data suggested 22,320 mark. That was going to be important on the downside. When you have shorts in the system, well, it gives you some cushion. Explains why we have seen such a big increase from the low point of the day. But let's keep equities aside. Let's focus on the commodity space. Manisha Gupta joins us to fill us in with what's going on there. Manisha.
Thank you for that, Nigel. I'm looking at the crude oil prices because we've seen very volatile moves come into this one. We are holding back above $88 a barrel. Remember, last week was a 3% decline. But this week, we've more or less tried to play that range between 87 to 91 on the higher side. Well, the strength comes in on the back of decline in US dollar index, which is still holding below 106. And that has led to buying in many of these dollar-denominated commodities. So when you look at the crude oil prices for the month of April, we have seen 3% of gains onto this one. It clearly is off the high of $91.50 a barrel, which was not just the high in April, but the high for this year as well. Since then, this has continued to base as a resistance in case of the crude oil prices there. We also are looking at a very big gap when you look at the US crude and the Brent crude prices. So 83 and 88 tells you that there's a $5 of a gap between both the crude prices here as well. Markets also have reacted to the EIA data, which is showing 6.4 million barrels of a draw in the US inventories. Well, the street was anticipating 1.6 million barrels of a build-up. So this has been a surprise and is the reason that you are looking at that 0.5% of a gain for the crude oil prices there. Well, it also is about the US GDP numbers and the PCE index data that comes in from US in today and tomorrow, and that would give you further direction. Markets also have seen some buying ahead of these numbers. Well, this will tell you on inflation and the rate cut cues going forward. But most of the tangible commodities actually have come into buying ahead of this important data. And then there is a lot of contradicting fundamentals also continuing in case of crude oil prices is the reason that you have seen $91 hold as a resistance. The one is that oil tankers, which have been idling at Red Sea, have made now progress in deliveries, which is reaching its destination. So that concern about delayed and disruption in supplies also seems to be getting taken care of. The other thing is about lower expectation when you look at military escalation in the Middle East. That has taken some premium off the prices as well. Analysts would tell you that nearly $5 to $8 of a geopolitical premium buildup that we are seeing in crude is something that the crude prices will more or less continue to maintain. But if we see more de-escalation, then the crude prices can decline to 85 and levels of below as well. Well, US is looking to reinstate sanctions on Venezuela, which has already happened, and Iran companies, oil companies as well could come under that radar. That would be an added positive sense in case of the crude oil prices there. Interesting report from ANZ which says that the global oil demand for the month of April stands at 101 million barrels per day, which is still on the higher side. And we have seen demand continue on the stronger side from US. China physical markets continue to buy as well. And Europe, while has enough gas, but the crude imports there have been on the stronger side. So a couple of supportive factors coming in from there.
Okay, thanks a lot for that. Let's take a quick break. On the other side, we'll be joined by Puneet Chatwal, the MD and CEO at Indian Hotels, to discuss the company's Q4 performance. Stay tuned.
Okay, strong recovery from the day's lowest level, about 130 odd points worth on the Nifty. And there's a sharp spike, which of course is now emerging at this point in time. On the Nifty, if you want to see what is really leading this spike, Kodak, of course, is not helping the cause. But even without that, right, it's Axis Bank, the number one contributor to the index, 30 points. Number two is ICICI Bank. So in a way, the market making the assumption. Of course, Axis reported numbers, but even otherwise with Kotak, in important segments, credit cards for Kotak is not a big segment at all, but markets making the assumption that maybe the other peers there would gain. ICICI is at the number 2 position in terms of helping the Nifty gain, and number 3 is Reliance Industries, adding about 15 index points. So all of it combined, 50 on the Nifty right now. Let's put the focus on Indian hotels now. It reported its best fourth quarter performance ever. Margins have expanded and operating leverage. New businesses have also reported growth of about 35% or so. What's the outlook looking like for FY25? That's the question, isn't it? We have Puneet Chhatwal, Managing Director and CEO at Indian Hotels, joining us now. Puneet, good morning. Great to have you with us here on the program. Prashant this side. Travel and leisure and hospitality continues to boom. And I think that's what the FY24 numbers show us. Revenues for the full year have grown for you 17%. EBITDA is up 20%, margins of 32%, and net income up about 25% or so. Give us, to start off this conversation, let's get the numbers out of the way, and then we'll talk about, the finer aspects of the business, the nuance, etc. What's the guidance for FY25? Will you maintain this kind of run rate?
Morning, Prashant. What we have given as guidance is opening 25 properties at a minimum in this coming 12 months. And we had guided 20, we opened 20 last year. If we add the Tree of Life to it, then it goes to 34. So I think on a growth trajectory, we have been delivering on that promise, and the capital light growth is helping us drive the margins. And the capital heavy with good, smart renovations is helping us drive the operating leverage. And our guidance remains the same. Why change a winning combination? All we have done is we have increased the CapEx spend because we are going to spend a lot of money on digital initiatives, on our new ERP, on our new data lakes, on our new websites, which we start launching the very first one in the next 10 days, and then for all our brands. So I think with smart renovations, effective asset management, digital initiatives, growth on all fronts in terms of number of hotels, number of homestays. We signed last year 105 new AMA branded homestays. We are now more than 100 in operations. And also cumin, bringing cumin to every ginger property has proven to be a good formula for us. So all in all, we are very pleased with the performance, and we do believe that we're going to sustain it for many, many years to come.
So, again, got that, and that's well put, Puneet. Margins of 32% are maintainable in FY25?
Yes, for sure. We are not into cost cutting, as I just now said. We are actually spending. We are supporting our new businesses. And as you mentioned at the beginning, we are looking at 30% plus CAGR on our new businesses, which requires more advertising, which requires more websites, which requires more people. So we have been doing that for the last 6 to 9 months under the vertical of new business. And we are very, very, optimistic that this journey will continue because demand will continue to outpace supply. And for our portfolio, there are 2-3 important elements which have not yet kicked in. First, the foreign tourist arrivals is at an all-time low compared to the pre-COVID. Of course, last year we had the benefit of G20 in terms of statistics, but it still did not achieve the number of pre-COVID. So I think there is some movement expected to happen there, which will help our palaces and our iconic asset portfolio. Number 2 is US has been lagging behind also on the pre-COVID. And we have taken some steps which will help us going forward. And finally, I think the journey that we commenced on our not like-for-like growth with more than 90 hotels in pipeline, we expect to open more than 100 hotels over the next 3 to 4 years. This will really help because of the balance that we have created in capital-heavy and capital-light businesses.
Puneet, hi. Always great speaking to you and understanding how the hotel industry is shaping up. But I have a couple of questions, right? How long do you think this runway of growth is going to last? And at what stage of the upcycle are we in the hotel industry? Has it reached a mature stage already?
Sonia, can I answer a bit on a lighter note?
Always.
2 years ago, and I said the rates will go up. You asked me last year, I said, no, the best of the rates is yet to come. And my answer does not change. With the kind of service we are providing, and post-COVID, the divide in the West and the East has, grown significantly, that your ability to charge and people's willingness to pay has increased, and also the appreciation of dollar. Pre-COVID, we were at 65, 66 rupees. Now it is at almost 83 point whatever. If you convert that back for our most iconic part of our brandscape, that is the Taj, we are still like close to only $200 average rate. So I think this journey will continue. And as India grows from 5th largest economy to 4th, and then finally to 3rd, the per capita income will also grow. And if the per capita income grows, the discretionary spend becomes a normal consumer spend. And that has been my belief, and that's what we've communicated.
So you also made a point, Puneet, that foreign tourism is still relatively low and it's expected to pick up going forward. The other 3 pockets I wanted to ask you about, one is spiritual tourism. You also have the resurgence that you're seeing of medical tourism, right? I mean, that as well is picking up in a big way. And then you have luxury or premium tourism. Where do you see the maximum potential now over the next 12 to 18 months?
See, spiritual tourism is very important and has always been. Actually, we started talking a lot about it, maybe in connection with Ayodhya. But we have been in Banaras and we are expanding our hotel, doubling the size of the Taj Ganges because the demand level is so high. And, many other we have added a 2nd hotel in Tirupati. We have 2 hotels in Katra. So we are in 50 plus spiritual destinations with 60 plus hotels there. The beauty of spiritual tourism is on the room demand side, it helps you in resilience. So for good or for sad or for happy reasons, people do go for, spiritual weekends or weeks, if I may say so. The second important resilient factor that is a part and parcel of the Indian subcontinent culture is the weddings. This is a very big business in India, and we are very well positioned to take advantage of the wedding segment, and that keeps growing. But more importantly, I think a lot of people tend to forget that the facilities that have been built, like the Bharat Mandapam, the Yashobhumi, both in Delhi, the Geo in Mumbai, the Kolkata Convention Center, and many others that are coming all across India, the new 4-lane highways, the airports that are being added, doubling of the number of airports, the number of new aircrafts coming into India. This is going to lead to a very different kind of a positioning of the sector in the next 2, 3 to 5 years. And I just think at the moment, we have not even captured 5% to 10% of the possible demand because these centers are either in an opening phase or just open because of G20. But as we all, Sonia, are in Mumbai, if an event, a big event is happening at Geo, within the 5-kilometer radius, there are no rooms available. So these kind of structural changes and shifts are going to really boost the hospitality sector. And we being the largest ecosystem in this sector should get our fair share of that benefit.
All right. Hi, Puneet. You're sounding very, very confident. Now, Vision 2025 was achieved a year ahead. So what's the vision for the next 5 years, if you could run us through that? And also fill us in with what's the difference between margins between domestic as well as international business, and what's the upside there?
Nigel, I think on the guidance, we will very soon announce our capital market day and give it at the same time to all. But mainly the growth journey will continue. I think if 5 years ago we had said we'll be a portfolio of 300 plus hotels, and at that time we were 120, very few believed us. When we said aspiration 2025, that we'll do 25% margin, very few believed us. Now we have the other side. When we say 33, people say, why can't you do 36? So I think management's job is to navigate through all these situations. And I think 30+% margin on a healthy top line is good. And I would also like to state here today that in our last announced results, our standalone revenue is higher than what was pre-COVID for the consolidated portfolio. And it's not coming just from like-for-like portfolio. It's also coming from not like-for-like portfolio. So the guidance remains effective asset management, use capital heavy as an opportunity to drive higher returns, because we have such beautiful iconic assets which are sitting over so much of space, including FSI, that we can use intelligently, and we've been doing that. Drive margin expansion through capital light businesses as well as new businesses and scale them up so that the volatility in the portfolio declines to the best possible or the optimal possible level.
Puneet, one of the triggers that you mentioned, which could play out, is foreign tourist arrivals, right? Especially US arrivals from US, etc. What will cause that to happen? I mean, why is that still low, according to you, briefly?
There is a shift, just like there was a shift of, customer behavior during COVID and post-COVID and people driving with families on a holiday. There has been a temporary shift because of the pandemic. People have stayed more at home, and it was also complicated getting visas, etc. It took a longer time. And then we all know that in certain countries, we had also put embargo for people to come in. So I think all in all, everything also goes back to some form of a new normal. And I think in the new normal, the foreign tourist arrivals in India will grow exponentially in the years to come. And why should it not grow? We have 7,500 kilometers of sea mass. We have 500 plus beaches in India. We have the mountains, we have the temples, we have all possible religions represented in India. We have the Buddhist circuit. So as India grows, as India develops, all these new circuits are already developing and will develop. The life will not be just limited to Golden Triangle, Delhi, Agra, Jaipur, and extended to Udaipur. So it could be, Delhi, Banaras, Ayodhya, Sarnath, the Buddhist circuit, the Northeast, which is coming up very strongly in terms of business. So I think a lot of new things are happening in India, which should boost both domestic tourism as well as international, but more importantly, business. India is becoming a preferred business partner for a lot of important and large economies of the world. And I think that will bring in new business into metros, and the supply will remain constrained, which will give us as a sector the ability to charge and also have good occupancies.
Absolutely. Well put and well-rounded there, Puneet. Thank you very much for joining us. It's a pleasure having you with us here on CNBC-TV18, and good luck to you, to your team, which has been executing fantastically well over the last many years now. Thank you. Well, I think we're out of time completely here on the show. Markets steadied a little bit. I mean, it was looking like a bit spiky, but now about 40 points higher. 22,440 is where we are at. We'll wrap up this edition of Bazaar from all of us here. Goodbye. Thank you for watching. Chartbusters will pick up on the action in just a bit.